All right. Hello, everybody. Welcome back to the channel. We have Amazon earnings today. It is a big one, Mag 7 company. We also have a bunch of other companies like Microstrategy, Iren, Roblox, Fortinet. A lot of companies to talk about today. Before we get into all of that, obviously today is a bloodbath in the market. It is following the nastiness of yesterday. To give you some context, Bitcoin is now lower than where it was before Trump got elected. Tanner, let's just start with you. How are you feeling about today?
I was telling you backstage, I'm getting killed. But that being said, I'm a long-term investor. I focus on buying quality names. And at the end of the day, I don't think the thesis on many of these names has changed. We were all together here yesterday watching Google, and that company is selling off. So do I feel, worried or looking for an exit on Google? No, actually quite the opposite. Like these are phenomenal companies making a lot of money. Bitcoin, I mean, a little bit more speculative asset. I'm not even looking to add to this right here, but companies that are triple beating and selling off, that's a complete opportunity for me.
Jose, how are you dealing with all this?
Yeah, same as Tanner. I mean, portfolio is definitely taking a hit today. I think at the lows we saw when AI stocks took a hit in like late November, December, around that time era when like CoreWeave was like in the 60s and all these other players. So I'm feeling the pain, but long-term investor like Tanner, I actually made a few buys today. I was actually pretty excited. So I put some cash to work. Not everything, because obviously with this AI market, the dip cannot keep on dipping, but I was happy to put a little bit more into the market today.
Jose, also, your mic's a little loud. Just got to take the gain down a little bit on that. Neil, what are your thoughts on today's action?
I'll just say what everybody's thinking. This sucks, okay? This sucks. Of course, we're all long-term investors right now because what else is there to do other than holding this for the long term? No, it sucks because we don't know why. Like I think most of us hold quality companies, and just the price just comes down without any headline, right? This has been a dip after dip after dip. It's like, okay, yesterday I bought a good company at a good price. Guess what? Today it's an even better price to buy the exact same company without anything. Like yesterday, Rubrik announced their preliminary numbers, and they said that they're exceeding their guidance, which means beats across the board. You think the market cares? No, it doesn't. What is it down? Another 5, 6, 7, 8% today? You say 7%. So I might be laughing, but I'm only laughing because otherwise I would be crying, and I don't think you want to see people crying here on the stream. So it sucks. It feels like a DeepSeek type of moment. There's definitely DeepSeek vibes to this because of AI destroying certain business models and things like that. There is a clear rotation. I shared a screenshot on X where you can clearly see like Procter & Gamble, Coca-Cola being up double digits year to date. And then you have Microsoft that's down, I don't know how much year to date. So that is it.
Tanner, let's start with you on the Amazon coverage. What are you expecting on this one?
I mean, what would be really nice is 23% year-over-year growth on AWS. Anything more than that, I think, is sort of one of those Google Cloud moments where we all get to jump and cheer. And that's actually a much higher accelerated growth rate. Now, it is smaller in terms of the growth rates that Azure and Google Cloud is putting up, but they're at a much bigger base. They're doing about $34 billion of revenue per quarter, where Google just put up 17 billion, quarter before 15 billion. So they're growing from a much bigger base, but we'll see. I mean, is this a general cloud winning environment where Iren ends up putting up stunning numbers and Google Cloud and AWS put up numbers? Or is it a little bit of like what we saw from Microsoft, where maybe expectations were set high and maybe we see a little slight miss here? I don't know those answers just yet, but I am an Amazon shareholder and can't wait to find out.
Sam, I think this is the biggest position in your portfolio. Your thoughts on this one?
My thoughts is that I think they're going to crush it. They're going to crush the earnings. I did a post earlier on Twitter. It's like Zuckerberg, $120 billion, Google, $180 billion, and Jeff Bezos is laughing. It's like, you guys haven't seen nothing yet. You've seen nothing yet. There's gonna be a two handle there, that's for sure. AWS probably going to grow. I'm expecting 23%. Anything above that is obviously going to be bullish, but I don't know where this stock's going to go. It's trading below the 200-day moving average coming to earnings. It's not even holding it. Market is falling off cliff heading to these earnings. I mean, it could go up, and I'm hoping it goes up because, that'd be great. But just look what happened to all of these other mega caps that reported explosive earnings. Didn't matter. It got sold off. So I think fundamentally it's the best company in the entire world. It'll continue. It's a space play. It's a robotics play. It's a data center play. It's an e-commerce play. It's an emerging markets play. It's everything. But the price of the stock is it's really calibrated based on where the market's at. So, I think it's gonna be a great earnings, and it could make the market bottom, and it has the potential to do that because of all the sympathy plays it has. Everything data center, everything cloud touches it. So, I'm hoping it does bottom the market, guys. This is painful. Amazon is down 5% as if they just reported earnings yesterday. What is that? It's messed up.
I find the weird thing is like, what's the alternative? Is the market selling off Amazon, and we shouldn't be paying 31 times PE trailing on that company, but instead we should be paying 51 times for Costco and just accept that they don't even have a cloud business. Like the cloud business is actually making Amazon a worse off business for their earnings. Like I don't get it, man.
Jose, I got a question for you. Let's say Amazon says we are more intimately engaging with OpenAI, like Microsoft said for their RPO. How do you think that affects the earnings?
I mean, I think OpenAI has that negative effect right now. But the good thing with Amazon is they are a big player of Anthropic, right? I mean, Anthropic, we had 4.5 come out. I think we saw massive demand in like October. So that's still part of this going to be this quarter. One of the things that Google was really able to grow their cloud business was because they not only buy AI chips, but they also make their TPUs with Broadcom. We know Amazon actually also does the same, right? They kind of get their Trainium from with co-design with Marvell. So I think there's the possibility for a nice beat there because of the Anthropic side, and they also do have a nice amount of AI chips that they build their own, plus what they buy from NVIDIA. So I think we're going to see some strength there. Like Tanner mentioned, this is already a bigger player, so you're not going to see that 48% growth, but I'm expecting at least in that 23 percentage of or a little bit even north to that of what everybody is discussing. So I think they have enough to talk about Anthropic to kind of ignore a little bit of that OpenAI side that they have.
It'll be interesting how many times they cite Anthropic on this call.
I agree, and that should be a big win for them because it kind of feels like Anthropic is the reason for this SaaS meltdown, and if Amazon owns 20% of them, that's not horrible. Neil, operating margins, I think, is the biggest story of Amazon. Robotics should be a potential tailwind for operating margins. Do you think Jassy's going to spend time talking about that, or do you think him accelerating the AWS growth story is a bigger part of this call?
So, I mean, AWS, I think for the next 3 quarters, we see low to mid 20% growth, because this quarter you lap, I think, the hardest part, and then the upcoming 2, it's quite easy. As for the margins, last quarter we did see a little improvement from 32.9 to 34.6. Should see it go back to 38 or closer to it. Is it because of robotics? I don't know. I'm pretty sure they'll talk about robotics, but they will just focus, I think, a lot more. By the way, with Amazon, remember 3 months ago, we're also back to the same price as we were 3 months ago before they reported earnings and the stock jumped, by the way. But 3 months ago, it was a horrible earnings call, or maybe that was two quarters ago, where they just answered a question by more questions for 5 minutes. But this time, I think they just focus more on the cloud, like cloud, advertising. There's too much demand. And that's about it. It's Q4, so it should be a very good quarter for them. They will just say the same thing that we've heard Microsoft and Google say. Is it going to be enough? I guess in this market, no. yes, it's good for them that Anthropic keeps on growing and growing. But like you said, Anthropic is probably one of the main reasons why there is a huge sell-off in the software space, because the market believes that Claude is going to destroy everyone, although some companies, yes, but a lot of the big ones, I don't think that's going to happen. Like a FICO is going to disappear, or S&P Global is going to disappear suddenly. I think it's silly, but I don't make the rules. I don't make the rules.
The the weird thing is, for me, is we just saw Claude Opus just do another upgrade today, 4.6. Does this sell-off just continue to happen as they improve these models? Like, as the years go on, I don't just mean now, but as we end up seeing models that can address bigger and bigger problems, that maybe this doesn't even make financial harm to the companies that we're looking at, but just constant sentiment deterioration every time that these models get improved. ChatGPT just showed off GPT Frontier. Like, are we sort of at the start of this and this just keeps compounding?
I think for the software space, it's definitely going to have some fear like that. Like, every time, if it keeps getting better and better, you're going to continue to get that fear on maybe this is the model that's going to take my moat, right? Oh, it might not be 6, but 6.5 when that comes out. I think the market is always going to have that fear. But I think that's when eventually some people just step in and buy these companies, and I don't know, if create some form of law of like, this is just ridiculously too cheap. I mean, we saw with, I think, Unity Software when Google released Genie, which is like a 10-second thing that you can kind of play in the interactive world. I feel like now every time Google releases a new version of that Genie thing, you're going to see a lot of gaming companies continue to see that downfall. At least for the foreseeable future, I think any upgrade does create some fear to those players.
I also want to say the reason I think today's sell-off is being accentuated is because of this job market data. We had the highest number of layoffs in January since 2009. That was not good. New hiring was just 5,300. That was not good. And then you had the JOLTS data, job openings in America. Market one is 7 million. We came in at 6.5. 500,000 jobs went away. So the Fed didn't cut 2 weeks ago because they said the labor market risks have not been as extreme. In December, they said they were really worried about it. That's why they cut. I mean, you have this going back and forth by the Fed. Maybe now in March, they think the labor market is a bigger issue. But at this point, to what you guys are saying, I don't know if the labor market or rate cuts are the reason for this sell-off. This feels like a structural deleveraging out of equities. Where's the money going? It feels like cash. I mean, you can't really say it's going to gold and silver, because it's not. It's definitely not going to Bitcoin. So it's one of those things where I think a lot of people are scared. And as a result, if Amazon crushes earnings, we're just not going to be sure if the market fully rewards them, especially if they increase their Capex, because it seems like that's why the market got mad at Google yesterday as well. All right. We've got about 1 minute for these earnings. The other companies that have earnings today, we are not going to be listening to any of their calls, but we are going to do our best to try to get you guys the numbers as soon as possible. Reddit, Iren, which is down 11%, Microstrategy down 17%, Fortinet down 2%, Amazon down 4%, Bloom Energy down 7%, Affirm down 4%, CleanSpark down 18%, and Atlassian, that is also down 6% on the day. In terms of pump or dump, 55% of you said dump, 45% said pump. I think Amazon's around 405, so we might get some earnings before them, but these will be the companies that we end up covering today.
Yeah, I'm really excited for Reddit today, Affirm. I think that these companies are sort of sliding under the radar right now. I know a lot of people are focused on Bloom Energy, Amazon, Iren, but I wouldn't undercut the possibility of what Reddit and Affirm can do today. I mean, they're all going to sell off after anyway, but like still.
All right, Thursday, February 5th. Thank you, everybody, for being here. 4 p.m. The stock market is now closed. And now we wait.
That was a shorter one than usual, huh? That means the market is really not in a good place. If your bell ringing doesn't last for at least like 10 seconds, this is a bad sign.
Dude, everyone's
very bad.
Annoyed at the bell. I'm trying to give the people
if you ring it too much, it's gonna break.
No, but then everyone in the chat is like, we want the old bell back. It's like, what am I supposed to do? It's like, I don't know what to do at this point.
Well,
All right.
how do you rank your bells? Like I like the Tibetan bell.
In the past 24 hours, 426,000 traders were liquidated in the crypto markets. Total liquidations was 2 billion. The largest single liquidation order happened on Binance. Someone lost 12 million on Bitcoin. So you're seeing a lot of that leverage get out of the system now as
Did
well.
they report?
We're looking for it. Amazon is red, 2.3. Now it's green. A lot of these other stocks are green after hours. Iren's up 2. Amazon now she's red. 3% down. If it gets above 3%, it might be more legit. Before that, it has a chance to reverse. It's at 2.3 right now. Don't see the numbers yet. Now it's green. Now it's red. No, now it's red. Now it's actually red. 4% down. 4.3.
Oh gosh.
4% down. Now we're going down. 4.3. 4.3. Amazon, all right. EPS 195 versus 196. That's a very slight miss. Net sales 213 billion versus 211. That's a beat. AWS 35.5 versus 34.8. That's a beat. Operating margin 11.7 versus 11.7. That is in line with expectations, but it's not necessarily a beat. And honestly, operating margins are going to have to start beating for the stock to get some more love. EPS is up 5% year over year. Revenue's up 14% year over year. Small miss on EPS by 1 cent. A beat by 1% on revenue.
Iren right now. Iren. Check Iren.
Nothing really that crazy on Amazon. Iren's up 7.
AWS grew by 24%.
That's amazing.
That's insane.
I mean, that they guided for 20%, so that's amazing.
They did 27?
No,
24.
Oh, 24. Oh my gosh. Okay.
Amazon down 6% here, man. They're taking her down.
Atlassian's also moving up 6.7% right now.
Atlassian
Iren up 7.4.
Atlassian 7% beat on EPS, 122 versus 114, 1.58 versus 1.54 billion. They beat by 3%. So Atlassian, this is another SaaS name. Put up some decent earnings. That stock's up 5%. It was down 6% during the day. I still don't have Iren numbers. I'm trying to find them. I don't have it yet. And then we'll get deeper into Amazon.
Amazon's down 8%.
Oh my goodness.
Oh my God.
Is this not the most expected 8% decline on a Mag 7 after Google and Microsoft, right?
I've emotionally prepared myself for this.
I think here's the reason they're down 8%. Once again, Street wanted 146 billion of market of Capex. Amazon says they're going to do 200 billion of Capex, which is good for Nvidia, right?
Let's go, baby. That's the greatest hedge in the market right here.
Nvidia's up 1%.
Oh my goodness.
200 billion, bro?
Is Marvell moving? I know they're the ones that provide some of the chips for them.
Wait, we never got confirmation on that though. We never got confirmation on Trainium 4 or Trainium 3 for Marvell.
Marvell's up 3%.
But yeah.
Dude,
But
how do we have
Trainium 3 we do have.
How do we have a recession with 6 companies spending 150 to 200 billion dollars each in 1 year? I mean, like, goodness, dude. Amazon now down
Nvidia still a 4 PE of 25 with all this cap.
Amazon down 8. Nvidia's up 1. Iren. Okay, I don't have EPS numbers for Iren. I have revenue. They missed by 19%, 184 versus 226. Do these guys not have EPS expectations? Because I don't see those. Iren's pump is kind of gone.
What did you say revenue-wise for Iren? Less than 200?
184, correct.
So it's like a sequential decline, which means the GPUs are definitely not online.
I don't know that much about Iren, but
that was never, like you said it before, like this quarter is not the quarter for Iren.
3.62 billion GPU financing secured from Microsoft. We already knew that.
Fortinet up 9% right now.
Let's go to that. We'll go back to Iren in a bit. Fortinet is cybersecurity. That's up 9%. See if I can get those numbers.
5.6 now.
Bill.com is up 12%.
Oh, billings at earnings today? Okay.
Bill Holdings earnings. Wow. Doximity down 26%.
That's another SaaS name, right? Yeah, Iren has no EPS. So there's nothing to look at, but they missed revenue by 19%. Fortinet, let's see.
I shared the link for Iren stuff in the chat if you want to look at that.
Yeah,
Okay.
revenue down 23% quarter over quarter. for
Plains
Iren.
Park, what the hell is this? They missed by 440% on EPS.
Roblox
That's
just shot
negative.
up 12%,
Yeah, Roblox up
Plains
there.
Park missed by
13%, 14%.
Okay,
I
Plains
wonder for these Bitcoin miners, like obviously the price of Bitcoin, how much of that was priced in with these analyst expectations? Because I mean that would definitely hit their Bitcoin business if they're still in it.
Yeah, and that's probably why Clean Spark missed by 3% on EPS. Roblox is up 11%, trying to get those numbers. This one got hammered. It was at 140 in October. It was at 60 today. Fortinet, they beat by 9% on EPS, 81 cents versus 74 cents. EPS up 9% year over year. Revenues up 15% year over year. They beat by 2%, 1.9 versus 1.86 billion. So Fortinet put up some pretty decent numbers, and we'll try to get Roblox. Amazon, though, my goodness, 9 points. She's about to go below 200. The street hates Capex. Like, that's the only thing you can hate about this call, right?
Yeah.
Or this
Yeah.
earnings.
Google was down 7% yesterday and fully recovered. So I don't trust this knee-jerk move.
Reddit is up 10.
Let me just pull up this Amazon coverage real quick, and then we'll get into
Oh
Reddit.
man, the relaxing relief of Reddit going up.
Hey, Melissa. So it was a miss for the Amazon's quarterly earnings, $1.95 versus $1.97, which was what the street was expecting. Revenues were a beat, though, so sort of a mixed quarter on the top and bottom line. Revenue coming at $213.4 roughly billion. Street was looking for 211 or so. We're also getting AWS revenue numbers. This was stronger than expected. This is a key number that Wall Street looks for. 24% growth year over year versus about 21, 22% that the street was looking for. AWS revenue overall beat estimates $35.6 billion. We're also getting some online stores revenue. That was stronger than expected, $82.9 billion. And then we'll keep digging through this, guys. But the big miss here is on quarterly earnings. We'll look through for some guidance, but AWS also stronger than expected. Back to you.
Reddit had a pretty good earnings. 33% beat on EPS, 124 versus 93 cents. Revenue, they beat by 8%. Revenue is growing 70% year over year. EPS is growing 244% year over year, which is pretty good, to be honest. Amazon, wow, 10.1% down. Reddit's up 7. Iren's up 4. MicroStrategy flat. Fortinet up 9. Nvidia up a little bit. Marvell up 2. Roblox up 23%.
That's where it was like 2 days ago, right?
Basically. Roblox beat by 8% on EPS, beat by 6% on revenue. I don't know why that's so exciting to the street, but that's enough to pump it 24% right here.
Advertising revenue for Reddit grew 75% year over year. Gross margins was 91.9%. I love this company so much.
Yeah,
they authorized a $1 billion share repurchase program, and net income margin came in at 35%.
Never met someone that loved Reddit, but Tanner is one of a kind.
Sorry, I should say I love this stock so much. Let me correct.
It's a great company. They got really good margins, and they're growing pretty dramatically. They're the digital Wikipedia now.
Well, they're growth stock. They should be growing. It's just they got corrected pretty heavily over the past months. Well, all right. So, I mean, I'm trying to get more details on Amazon, but Jose, any raw thoughts on this quarter that you're seeing on Amazon?
No, I mean, I think you're right. I think the street is just hating on the Capex, and it's dumb in my opinion. But again, it's like the market. I think the market is getting a little bit scared that are we pulling Capex too ahead of ourselves right now? Is there really that much demand? And I think it's just that fear there. And then after Google, right, reported that massive revenue growth in cloud, and even though it did beat, it wasn't like that massive beat that we saw with Google Cloud. So now it's like, is the market also saying not only are you spending crazy amount of money, but are you also going to start losing market share to Google Cloud? So in my opinion, that's like the optics of it. I wouldn't be bearish on Amazon here, but if there were negative optics, I think it would be that.
Dude, Roblox, I don't know if you're looking at this stock right now. It's up 18+%. They beat on EPS by 8%. Still in negative numbers, however. and revenue beat by 6%, growing 63% year over year.
Yeah, see, this is a weird market. To take Amazon down 10 and to give Roblox an 18% move, it's a little weird.
Honestly, I think Reddit is so, like, the stock is doing such a disservice right now. They beat EPS by 33% and revenue by 9%. Once again, they show that Wall Street has no idea what this company is going to report. This should be the company that is up the most today. I mean, huge beats, continuous execution. What a phenomenal company. Stock, sorry, my bad.
Here are some of the quotes from Iren CEO. Last quarter marked meaningful progress across capacity expansion, customer engagement, and capital formation. We are seeing the strongest demand environment to date, and importantly, that demand is being proven by execution capability. Over several years, we have consistently delivered data center capacity on time and scale. With more than 4.5 gigawatts of secured power, we are able to advance a broad set of opportunities in our pipeline. Our 3.4 billion ARR target represents an early stage of monetization relative to the size of our secured portfolio. They have $3 billion in cash, 3.6 billion GPU financing secured. Revenue did decline though, quarter over quarter.
So if you scroll all the way down, the AI cloud service revenue actually increased $10 million quarter over quarter, but Bitcoin mining decreased substantially, which is why we're seeing a quarter over quarter decrease in revenue. But the fact that AI cloud service revenue finally, I mean, it's now 17.3, voila. 17.3 instead of 7.3 last quarter. That should continue to increase substantially in order for the market to detach this name from crypto mining business.
Iran is now down 5% after hours. What a market, boys. What a market. I mean, this is
Amazon's back above 200 though. It's not continuing to drop. Maybe we saw.
Oh wow, it dropped below 200.
Yeah.
We did see below 200 here. Trying to get Amazon's actual press release. That's not on their website yet. At least I can't find it on their website yet. Here's real quick Reddit. And then we'll keep going from there.
$600 million. Estimates were for 577, guiding to adjusted EBITDA of 210 to 220 million for the first quarter. Now, daily active uniques, 232 million, 1 million ahead of estimates. Global average revenue per user, $5.98, well stronger than anticipated. You see shares are up as much as double-digit percentage points, now up just a couple percentage points. I spoke to Reddit CEO Steve Huffman, who said, quote, "We're seeing this macro shift towards AI, and Reddit stands out as the most human place on the internet," saying, "I think that's why we're seeing the results we're seeing right now." He went on to say, "For our AI partnerships, our conversations are shifting from a deal to a product partnership." Melissa?
Julia, thank you. Julia Borston. Let's get back to Michael Farr. So we're seeing.
Oh boy. All right. So Microstrategy, for those that are asking those earnings, again, I don't think the earnings really matter for MSTR. It's just Bitcoin. But trying to get some numbers on it. Affirm, we just got theirs. They beat by 37% on EPS, 37 cents versus 27 cents expected. Revenue, they beat by 6%, 1.12 versus 1.06. This is another fintech, Affirm, down 5%.
Yeah. One of the greatest fintechs, by the way, in the market.
Tanner, any, by the way, this is what Saylor said. Any quick thoughts on why you think fintech, Hood, SoFi, obviously everything is getting hit as bad as it is?
No, I mean, Hood is like, when the markets do bad, high beta, all this stuff is getting crushed, crypto's getting crushed. There's real impacts to their earnings, right? It's not just like other names where sentiment changes and people question whether or not Google and Amazon are going to be able to make a good return on this Capex. Hood literally sees an impact whenever there's a slowdown in options volume and crypto getting crushed. So there's real reasons to sell off Hood, but maybe just not to the extent of what's actually happening. So yeah, 50+% drawdowns from its highs, I think is a little dramatic.
Yeah, but it literally, like I shared the thing on X today. It literally followed Bitcoin. Like the moment Bitcoin topped, Hood topped, and it crashed approximately also 50% to the dot.
Yeah.
Which is strange because only 21% of revenue comes from crypto. Of course, sentiment around the current market expectation. I mean, the current market, so maybe people are trading less options, which is also a big part of the overall revenue. I mean, big-ish part of the overall revenue. But I still think prediction markets can offset a big loss from crypto. But sentiment is sentiment. I mean, next week is earnings. Then early March, there is another event. I think they want to show something. I don't know what it will be, but for now, it seems like this is one also that as long as Bitcoin continues to go down, HOOT will just follow it every percent on the downside. And SoFi, I don't know. I mean, SoFi triple beats across the board for the last 2 years. This is one of those names where, I mean, Tanner, you remember the time where triple beats brought us from $6 to $7 back to $6. Now we're under 20. Who knew this would happen? But I don't see how Claude or AI is going to disrupt this business. Actually, I think it's making this business much better. So yeah.
Yeah.
I'm not sure.
A little bit more coverage on Amazon here.
For those, Kate.
Hey, Mel. So Capex is the big one investors were looking for. $200 billion, I know you guys just mentioned. That was up from a total in 2025 of $150 billion. So massive acceleration in Capex by about $50 billion. Stock has been taking a hit. There were some jitters around how much Amazon was meant to spend on this, and investors were a little shy about sort of the fine line that they have to walk here. International revenue, should also point out, $50.7 billion. This was a beat, up about 11%. Important growth area for Amazon. Also on revenue guidance here and operating income, guidance looks to be pretty much in line. Operating income guidance was slightly lower than what the street was looking for at the midpoint. And that could be another thing here, sort of weighing on the stock. But I would really point to the Capex number as a potential drag on Amazon right now after hours.
All right, Kate, thanks. Kate Rooney. We want to go to Julie.
Real quick, Roblox is at 24%. I went and started to get their numbers now. There is a couple really, really interesting statistics. I think that I have a moral qualm with this company, and we can talk about that later. But look at their daily active users globally right now. Take a look at this.
Oh, you're sharing it? Okay.
Yeah. Unreal. They're growing daily active users by 70% year over year. That's skyrocketing to 151 million people. 4 quarters ago, that was 85 million. That's a little insane. I mean, the numbers on this company, whenever we take a look. Now, I will never touch this company. I think they're a bad business. But total revenue up 43%. I'm pretty sure their net income also grew by some crazy, 43% on net income growth, nearly 44%. They're pretty interesting. Bookings skyrocketed. Bookings here up 70%. So there's no wonder this stock is up nearly 24%.
Do you think can they grow DAU 70% again? Like, is the street really pricing in that type of sustainability of growth? I don't see that happening.
I mean, their goal is to reach, what did he say like a couple of years ago? 1 billion users, right? I think that was his goal of the CEO. The thing with Roblox is every metric goes up. Earnings, they still don't really make money. Like there is cash flow and all of that, but there is a huge opportunity to monetize all of it. They just have to figure it out. Because if you have so many daily active users, and a lot of them, previously the problem with Roblox was, most of your users are under 13. Once they go to the above 13 group, who maybe they won't stay on the Roblox platform, but clearly they do. If they figure out the advertising monetization model for them, I mean, this thing can just print money. I just don't know if they'll figure it out. Yes, there are definitely some issues with this platform, predatory issues, but it's insane. Like every kid is on Roblox for this stupid brain rot game, which I still don't understand.
By the way, guys, real quick, Molina Healthcare just dropped 30%. This is a pretty important healthcare
This
company.
is a Burry pick. This is a Michael Burry pick again.
It's not as big as UNH, but
Bloom Energy up nearly 10% now. They just skyrocketed 10%, 10.5.
Tanner picked all the green stocks.
Oh, let me try to get the Bloom earnings. But Molina, yeah,
No,
that
I'm
is
picking
a
the
Burry
popular stocks.
pick. That is a Burry pick.
I don't cover Molina Healthcare.
Bloom, they beat by 50% on EPS, 45 cents versus 30 cents expected. Revenue 770 million versus 645 million, beat by 21%. Double beat for Bloom. That's good. This is one of the players that they signed a deal with Quanta. They're an AI story. I mean, you want to see some of these names put up really good earnings to justify the growth they've had. This stock is up 70% for the year. So this was a relatively good quarter. Reddit's up 5%. They had a great quarter. Iren's nuked 14%.
Destroyed.
That's not good.
14%.
Nebius is following. Nebius is down 4%. I mean, I do agree with you, Tanner. Nebius, I do think, is a much more well-rounded business than Iren, but they're going to have to put up some good numbers to not have to deal with this same outcome.
Bloom's up 17%.
Yeah, it was a good
Go
quarter.
back to 160.
They beat on the top and the bottom by double digits. I mean,
I don't trust that. I don't trust the Bloom Energy move. Just looking at the way energy stocks have been moving lately, or sorry, not energy, but like specifically data center energy, LEU, Oklo, all that stuff. I mean, Bloom Energy obviously is a much more reputable one, but no, I don't trust it. We'll see though. I mean, I don't have any leg in it.
Oscar's down 4%. What the heck did Molina say?
Yeah, something happened.
Your healthcare stocks are just getting destroyed at this point. You know what this earnings is reminding me of, and I know a lot of us have been talking about it today. It is feeling like a 2022 type of beginning of earnings cycle where just things are falling for no reason. Some things are going up, and those moves are getting reversed. And we can talk about that before the call, what this feels like. But you're seeing every sector find its own pain.
So you called out the beats on Bloom Energy. Did you say the amount that they beat by?
Yeah, let me pull it up.
They beat EPS by 50%, beat revenue by 21%.
Yeah, exactly.
You know how wrong Wall Street has to be to beat revenue by 21%? That happens so infrequently.
Well, again, if a lot of their demand is coming from data centers, which if Amazon's spending $200 billion on Capex, they're going to need energy, then a company like Bloom should beat really well and should be rewarded for that. But why is Amazon not being rewarded for them? It's like, that's the confusing nature of this. Like, traders are buying Bloom over Amazon. Not saying Amazon's a better buy, but to take Amazon down when Amazon is a metaphor for the data center demand that is leading to Bloom getting all these beats, that's confusing. Or AMD, for example, getting hit. AMD after hours, by the way, down another 1%. Broadcom also in red. Broadcom down 1% after hours as well. Bitcoin,
$200 billion, right? So let's sell off the infrastructure names.
Yeah. Reddit lost its pump. All of it.
Yeah, I don't.
Tanner, you still love this one now?
Dude, it's doing so well. I can't tell you guys how hard it is to hold up 70+% growths for like quarter after quarter after quarter. They're doing great.
Dude, Pouncer put up 70% growth and also got hit. It's the nature of this market, right? It's the nature of this market. I agree with Chris. NVIDIA and Broadcom selling off with all this CapEx spend makes no sense. It really doesn't.
Literally, we all thought OpenAI was crazy for spending like $1.5 trillion with these 5+ year terms and everything like this. That's exactly where Amazon, Google, Meta, they're all headed for the exact same amount of spend. They all see it. This is going to be $1 trillion a year cycle, just like Jensen had predicted years ago. I've got nothing to do but double down on NVIDIA. I mean,
but one has the money, the other can't answer the simple question: do you have the money or not?
Neil, if you want to sell your shares, I'll find you a buyer.
I don't even think he wants to say it these days because nobody's going to buy it.
Isn't crazy to think that after all this pain, I think this is going to probably want to be one of the you could just pick a Mag 7 from here on out and probably outperform the market. It's crazy, these sell-offs on like Amazon, on Microsoft, on these other players, on Nvidia. I think this is a market where you don't even have to go find hidden gems. You can just pick a Mag 7 and you'll be good. Obviously, in the short term, it doesn't look like it, but based on these valuation, these growth potentials, like it's like, why do you need to look at somewhere else? You could just focus on Mag 7s, and I think you'll be good.
I don't think that's crazy. By the way, the MicroStrategy earnings call today looks like it's going to be a panel at the Bitcoin Magazine conference. Tom Lee, Lynn Aldrin, and a couple other people. Or has anyone ever seen I don't know why this is happening. It's supposed to be an earnings call, but I guess it's not. So
An earnings call without earnings.
Yeah, it's become a celebrity event, just like the shareholder meetings. Like there was like a penguin driving a car. Like usually these are boring corporate videos.
gold is down 3, silver's down 14. The precious metals are feeling the same pain right here. All right, so we have 30 minutes until the Amazon call. Those were all the earnings. We'll get you all the rest of the headlines as they come in. But I mean, let's start the conversation right here about the macro.
Can I do one more numbers that came in?
Go ahead.
Foxconn reported, according to Bloomberg, $23 billion for January, up 35.5% year over year. So they supply chips for NVIDIA and Apple as well. Up 35%.
That's good.
Yeah.
It's not bad. It's decent. Tanner, let's start with you. You think this is feeling 2022-esque? What are you thinking?
Yeah. I think that there's going to be some great traders out there that are able to maybe rotate out and find what works. But me, I'm a simpleton. I only know 1 or 2 sectors, and I'm just going to stick to those and double down because I'm seeing all the companies that I'm covering are essentially showing off like these triple beats and raises. And I just like these companies more and more. And now they're cheaper to buy. So I like Google. I mean, that they probably won in terms of the Mag 7 earnings. I think Google probably was the biggest surprise out of all of them. Amazon did well. Meta, fantastic. So, but Capex, all this Capex is the big concern. 46% of my portfolio is sitting in NVIDIA shares, and I think that they'll be a big beneficiary. So I feel well positioned. It's not necessarily a hedge, but it is a Capex hedge, right? Where does the spend go? So I feel well positioned in the Mag 7 names, in other tech and advertising names as well. I think, honestly, Reddit can do whatever it wants, but these were phenomenal earnings. And yeah. What a crazy market. Even Bloom's now selling off. We're up 6% now.
Wow. Hold on. It just went from 18 to 6?
Yeah, 5 now.
Sam just called it. I mean, it's hard.
Told you, dude. I don't trust some of these moves. Roblox might stick, though. I feel like Roblox is going to stick, but that's where it was like. It was just there like last week.
Bro, Atlassian was up on earnings. Now we're down 7.
If you want to know a company that's going to be disrupted by AI, it is Atlassian. And you just like
this is the company that does the whole Jira tickets, right?
Yeah, they have like basically every single enterprise under their belt. I think the issue with them is that they already do. So where is the growth? So that's their ARR is in line with their growth. So they increase prices, people pay more, the revenue goes up. So it's based on seat count. So if you don't need that much overhead as far as your licenses for these software companies go, then they're going to start losing money. And that's probably the reason why it's going down. But this is ridiculous though, because everyone uses it.
All I remember is I once was in a Jira team project and I was getting assigned these tickets and I hated everything about it. It was the worst experience ever. I just
you should have shorted it.
Wanted a Jira ticket again in my life. So
I'm going to vibe code something new for you, Amit. We're going to solve this.
Quick question. I keep hearing that 2022 vibe. What does that mean? I'm a little lost here.
Okay, so I did a little bit of research on this today. The 2022 vibe was the market was shifting its perspective on how to value companies because there was some catalyst that changed everything. The obvious catalyst for 2022, well, two things. One was midterms. Historically, midterms are just not a good year. And then second was rate hikes. We don't have rate hikes this year. We do have midterms, but we have a host of other catalysts that are not as easy to point to as rate hikes. And there's a good video on this that I'll share in a second as well. But a lot of those catalysts we've been trying to figure out over the past couple of days. Is it OpenAI being this like big boogeyman around RPO and AI growth? Is it SaaS being decimated? Is it Capex being too much? Is it the AI trade just being exhausted? Is it we've had a 3-year bull market with basically 20%, 20%, 20%? We need a consolidation year before things go like very normal things that could realize a 10, 15%, 20% downward year on the S&P, but it would coincide with the 4-year presidential cycle, the second year being the worst. And it would also allow the market to kind of catch its breath before going higher, which also makes sense with January, right? Because January, we saw these crazy high beta names go up literally 5x in a month. And maybe that was the clear signal for things need to slow down.
BFA fund manager survey indicates cash balances are at a record low.
Well, that stat is also very similar to FINRA margin being at a record high. Everyone's levered up, including the big guys. It's not just retail.
Just wait until they start downgrading their S&P targets. That's when things can get pretty bad, because they always adjust their S&P price targets based on certain ranges in the market. And everyone was bullish. This is kind of what happened last year. Everyone was bullish. Every IB sell-side analyst was bullish. But then you saw like they started lowering their rate. They started lowering the S&P 500 targets for last year as the market dropped. So we haven't seen that yet. But, you know, at the end of the day, I mean,
to your point, Cam, people are going to cash. Money market funds, 85 billion increase this week.
There you go.
That was 130 billion decrease 2 weeks ago.
Yeah.
It's weird. I feel like, I don't know. I feel like in the panel, we're feeling pretty scared, but that's actually making me very bullish. I feel like I'm hearing very, very shy from everybody here. And it's like, maybe you guys are not trying to. Obviously, you guys are just reading things, but like all this bearish news is just like, maybe we are closer to the bottom than maybe we think.
Could be. Who knows?
That's what we said last week. And
I mean, who knows, right? But I think we all got like our head on a swivel that we're not going to be like trying to call bottoms every day buying calls, right? So
yeah, and I think all of us we all lived through 22. I think most of us. There might be some people in the chat that weren't around during that time, but that was not fun. And you know, give us the 20% drawdown, and that's exactly what liberation. It's not fun when it's prolonged, right? That's when it gets a little ugly. And the risk on assets not being risk on, Bitcoin being a primary indicator, it's almost like it's a leading indicator potentially for the market.
Someone said in the comments, like, what is the catalyst to turn this thing around? Like, what would be like one day we wake up, oh, market is up 3%. Like Liberation Day, there was a clear catalyst. Trump changed his mind. DeepSeek, people figured out that it doesn't really matter that much. So this time around, what will be that one headline or I don't know, something that is the necessary catalyst to turn this thing around?
It's the same thing every quarter. NVIDIA is going to have to hold up the entire world on its shoulders.
No, but at this point, even if NVIDIA crushes it, I don't like...
Yeah, no one's going to care.
Yeah, because all the Max 7 are telling you NVIDIA is going to crush it and no one cares. And that, to your point, Jose, about why does it feel like 2022? Any piece of good news back then it just didn't matter.
Exactly.
And I don't know. I think this was a good video by Mark Newton today, and this was his thoughts as well.
That have really gone sky high, the Western Digitals and the Seagates of the world. You know, it's not unusual to see the areas that have seen real froth start to come back to life. We saw that in cryptocurrencies, it spread to precious metals lately, and now more recently software. So I think investors need to be prepared for that also to happen. The second reason is that, you know, heading into the second year of a second term of a presidency historically has not been kind to the market. We saw that during Truman, Eisenhower, even more recently, you know, Obama, Clinton, George W. Bush. So, you know, normally when you get to that second term, that midterm election year, you tend to see volatility. And, you know, the third reason is a new change in Fed leadership is going to be really, really important. I think that historically the max drawdown has been about 17% when you look over Powell, Yellen, Bernanke, and, you know, and Greenspan. And so Greenspan, of course, presided over the 87 market crash. So I think that honestly, for the investment public that sort of parses over every word that we see from the Fed governor to now have somebody like Warsh step in, where we're not certain of what his communication style is, what his leadership is, what his message will be, what the path of the rate cuts will be. And my thinking is the markets are likely going to experience some volatility that coincides with previous times when a new Fed leader has stepped in.
So you laid out there how we could see the volatility play out. Mark, what does this mean? A pullback perhaps of 5%, 10%?
Yeah, I don't think it's imminent, but I do suspect that by the month of March, we are going to start to turn down. And that means probably 15 to 20%. And that really is between March and October of this year. So I don't sense we go into a bear market per se, at least by the media's definition. But I think that in general, we're going to need to reset and show some consolidation on many of these high flyer AI names where, many companies are still struggling to really realize profits on their investments in AI. And we're just not certain how that's going to materialize. So many of them have gotten very overbought. Technology still in a major longer term bull market, I would argue. But after 2 straight years of 20% returns and then 17% last year, we likely need to reset that. And this is the year likely that it happens, coinciding with a lot of really prominent cycles that suggest that markets need to pull back.
And you've laid out some of those cycles. Any other ones our viewers should know about?
Well, the most important for the entire stock market's really the 41-month cycle. It lasts about 180 weeks by Edward Dewey. It's presided over the majority of the larger sell-offs over the last 100 years. And so it happened at the peak of the 2000 when we declined into 03 from 07 to 09. It peaked in 2021 down to 2023. So this is the year when likely we're going to see some consolidation, I think. We really want to be aware and probably properly diversify and not just put all our eggs in one basket into technology like many have gotten used to in recent years. There's plenty of areas within energy that are working quite well. Of course, Iran tension is part of that. Materials, commodities, emerging markets that look actually quite great. Looking at the LATAM space with what's happening in Brazil and Mexico, and even areas like China that are gradually starting to rally again. So I think investors really need to consider stepping out of technology to some extent this year and letting it reset, and then it'll be time to buy again by the third quarter.
How does that?
Basically saying we're not going to bottom till October, which was exactly 2022.
So Warsh probability of being nominated is 96% right now. Why isn't that 100% is my question. So that could be the bottom. But like you mentioned with the Fed, I said this yesterday, man, like it is the Fed, right? You don't expand liquidity in the Fed balance sheet. I know, Jose, I know this stuff is not really important, to you long term. Like, it's more about, sorry, short term. The long term is obviously what matters, right? Especially if a longer time frame. But I mean, if Warsh comes in here and he's like, I'll drop rates, but I'm not gonna do QE, like the market's gonna hate that because we thought we were gonna get more juice for another 2 more years. That's not happening. So the market's scared. And that's what we're seeing.
Could I get clarification on what you just said? You said the prediction markets are currently setting Warsh at 98%. When it hits 100%, that's a signal for the bottom in the market?
No. I said it's 96% for Warsh, which means that there's a probability that Trump will not officially nominate Warsh because he technically has not. It was just a tweet, right? Or it's just a truth. So if he doesn't, then that reverses all the thought that we are going to get quantitative tightening or stop quantitative easing, and the market will probably bottom that day. But if that becomes 100% where he does officially nominate him, then guess what? Now there's massive uncertainty as to what he's going to do. And if quantitative easing getting cut off is on the table, the market will not like that. And ultimately, we've seen massive drawdowns since last Thursday. It's Thursday, right? Yeah. It's when this
guys
accelerated.
After hours is a bloodbath. Zeta's down 6. I don't know why. SoFi is down 3 after hours. I don't know why. Where's Hoodie? Hood is down 2 after. I mean, after hours, it's just Nebius down 4, Broadcom down 1, AMD down 2, Palantir down another 2. S&P's down another 0.5% after hours.
People are calling Nebius has at least a reason to be down. There might be one of their peers that's down a ton. Like I get that. Why is SoFi down?
Yeah, why is SoFi down?
Are you worried about the personal loans that SoFi gave to Amazon? What are you worried about?
Because they sold SoFi to buy Roblox.
Yeah.
Oklow's down 3. It's Bitcoin. Well, SoFi's not related to Bitcoin. Not really. Bitcoin
no.
The Qs are down 74 basis points. High beta is going to go down. That's just how it is.
Yeah, I guess
you don't
so.
need an excuse. 2% isn't bad when you think about it. That's not that bad.
These are one of those days where it feels like the bottom is falling out. And the worst part is we don't really have a reason other than Amazon's Capex, I guess.
Yeah, but you know, the 2022 vibe thing, at least in 2022, the reason why we see some huge corrections there is because we were trading at crazy valuations. Even the top companies were trading at like ridiculous valuations. Today, it's not the case. Like
No.
today, like you said, Nvidia is forward earnings 24, 25. Meta is low, Google is low, Amazon is lower than before, Microsoft is low. Like the best companies on the planet are trading at good pricing metrics, let's say, compared to 2022, which was not the case. Plus inflation was going super high. Interest rates were climbing. Right now, yes, okay, with this new Fed coming in, by the way, even if he's nominated by Trump, he still needs to pass the Senate grilling, because like one tweet or one thing doesn't make him the Fed. You still have the criminal investigation into the current Fed, which at least some politicians said that they're not going to advance with war as long as that thing isn't over. So he has maybe he won't be appointed. Who knows? We don't know. So the market is in a we don't know type of situation. Coca-Cola is, I think, at all-time highs, which I guess explains this whole market situation right now.
Yeah, I mean, I think the market is trying to look for when enough is enough, and it's only the beginning of February. To your point, Neil, the most high beta stocks that are super expensive, they don't really affect the market. So if the Mag 7 were trading at crazy multiples like they were in 21, that would be a different story. I guess my question is, where is this money going? Because if it's going to freaking money market funds, those rates are going to be down at least 50 basis points this year, unless people are okay with just getting that type of return. It's not going to gold and silver. I mean, maybe some of it has, but that's really volatile. It's not going to crypto. I mean, yeah, maybe it's going to Walmart and John Deere and stuff like that, but eventually you would argue it's going to come back to Amazon. It's going to come back to Nvidia. The question is when and how long. Is that in October or is that next week? Or is the market predicting a recession? I mean, that also is kind of what it feels like. It's like they're ready to take Amazon down because they know that no one's going to be buying stuff soon.
This is there's going to be a recession everywhere but Roblox. I need a small loan of $1 million for real. Just
Money
small
market
loan.
funds. No, well, I was talking to a friend the other day. He maxed out a couple credit cards to buy the Rocket Lab dip in November, which is kind of crazy, right? Super risky, but it worked because we're in the buy the dip generation, and every time we've been rewarded by buying the dip. This time you get that $1 million loan and you buy the dip and it doesn't, like that's the scary part of.
Yeah. It's like rolling a die, right? 50-50. You roll. I'm sorry, rolling a coin, flipping a coin. You get heads 3 times in a row. Then what is that? Like a 12% chance. And then you bet the farm on the next one. You have 50% chance of losing everything.
Here's another argument. Is it just okay? SoFi went from 4 to 25. Palantir went from 6 to 200. Hood went from 7 to 150. Rocket Lab went from 4 to 99. Is it just normal for them to correct 50%? Because if Palantir goes from 200 to 100, it's still up from 6 to 100, right?
Yeah, it's up from 6 to 100, but also there's an underlying financial aspect that's also has gotten better. This is not just like Bitcoin is just sentiment, right? Like that could just keep going down. But Palantir has made more money every quarter, and I don't have to rattle off all the statistics to you, but like it is a different business than whenever it was an $8 stock.
That's fair.
Same with SoFi.
Same with SoFi. Same with Rocket Lab.
We weren't profitable before. We are consistently profitable and beating every expectation right now. Do we need to correct? I mean, some names didn't even need to correct to be priced priced fairly. Some others, yes, but I don't know. What is Oklo's market cap still today with zero revenue?
$9 billion. Yeah. Well, here's the broader question. Like SoFi, I think at a 50 PE when we were going into the print, and now it's like 35. Tanner, are we just entering a world where the market's not going to give the 50 PE to a company growing 40%?
Bro, you're asking me to. I don't know the answer to that. I think a company that's growing 40% 1 year, that's one thing. A company that's guiding for growing EPS at 40% over the next 3 years. I think it's really hard to visualize what that growth looks like. And at least on the revenue side, which they always sandbag their guidance and somehow end up putting in better numbers than expected, they're expecting to do 30% revenue growth for those 3 years, which would take their yearly revenue from 3.6 billion to 8 billion. Well, I do think that there's a premium that should be paid for a company that's going to more than double at higher margins, by the way. They're increasing margins and increasing revenue during that period. It's not going to be the same company 3 years from now. I think that deserves a premium.
And don't forget that you probably know it. The EPS this year, right, is approximately the same range that they've given before. They're still going to meet it with more shares, which makes it even more impressive because if you remove the dilution, it's even better.
Yeah. By the way, they should take the $3 billion that they just raised and go buy the stock back. all the shareholders would be nice and happy the fact that they diluted at $27.50 to buy it back at 19 here. They won't do that because there's better use of that capital. But I'm just saying they have a ton of flexibility, and unlike us with no cash, SoFi has a ton of cash, and they could be going into this market with, SaaS names and fintech names being sold off, and they could be a big buyer in this market. So I think they have a ton of flexibility where the rest of the market really does not.
The other thing that's important is the Buffett indicator has been flashing for the past couple of months. The Shiller PE ratio has been, some of those core
40 times.
Yeah, some of those core basic things, maybe they're starting to matter a lot more and come into play.
But that's what I look at, where I see like the Shiller PEs at like 40 times or something. And then the big tech companies are at 30 times, 28 times. Like these are some of the cheaper names in the S&P 500,
right?
With fortress balance sheets and free cash flow. And like some of the smartest people in the world are working for these companies, and people are giving that no benefit at all.
Iren's down 12 now.
And then you see net profit margins be at record levels not seen since 20 years or maybe even more. I mean, when you see margins, net profit margins and things like that at record levels, why shouldn't we pay a little premium on it? And it's not like we're paying crazy premiums on the best companies on the planet today. It's just one of those weeks, I guess. I don't know how long, maybe it will be months. I don't know. Like 2022 was like a harsh year because like the bleeding was like non-stop month after month after month after month. Last year we did bleed, but at least like we bled for a week and then it was over. It's like when you have to rip up a band-aid, like don't do it slowly, like do it in a day or two and we're done. Thank you very much. Reset and we're back. But maybe this time is different.
Yeah, and the difference between people are asking about what happened about COVID. Within 2 weeks of COVID being a thing, we turned on the money printer and we turned it on aggressively, which led to the 2022 decline eventually.
So Marsh doesn't believe in that.
Yes.
Until it's like absolute catastrophe. And he would not do that. That's the scare with that one.
Dude, why do you think Trump picked this guy?
I think maybe Bissent convinced them. Also, Fred's credibility could be on the line if he chooses someone favorable. So he's not going to lean toward political motivation, that's for sure. And it's that trifecta. It's Stanley Druckenmiller, Bissent, and Warsh. Like, dude, that's scary. But they all believe in short-term pain, long-term gain, though. So if you got to rip the Band-Aid, I would say do it. And then that way we can just like move on to bigger and better things after that. Because we are in the middle of an AI cycle. Like this dip's going to be bought at some point.
Yeah, I don't know if Trump can necessarily save the short-term pain for long-term gain.
No.
Jesus. If we're going to have pain, we're going to have pain. The 10 years at least coming down. I mean, this might be part of the reason he picked Warsh, to get people to feel comfortable enough to buy bonds.
Nebius is $69.50.
Yeah, that's disgusting.
Did you see that post that said, I was praying for a 69 tomorrow, but I didn't think it was going to be Bitcoin. Oh, man.
See, but the thing is now it's literally every stock. Like there really is. I mean, maybe Verizon and J&J and some of those safety names, but most people are not necessarily full porting Verizon, right? So there's really not a good place to hide across the board. SoFi down 3 after hours, Reddit down 2 after hours. Webull is about to go below $5 after hours. Bloom Energy still up 10. D-Wave down 5. Quantum getting hit. It was down 14 today. Those quantum stocks have been hit pretty damn hard. Intel's down 1. Silver's down 3. Tesla lost 400 today, 391 after hours. USAR down another 4 after being 12. MP down another 1 after being down 6. Palantir 125. That one is getting hit. BMNR obviously getting hit as well. Micron still down 3% after hours. Apple, I mean, Apple's 270. If they take Apple down, then we know things get ugly.
Yeah.
Who would have known that Fundstrat ended up calling that first half 2026 Ethereum price? He said 2,000 to 1,800 as a base case, and actually I think since then he's actually pulled that statement back. I think Tom Lee might have had a chat to him, but it actually came true overall. And by the way, that same person also believes that Ethereum is going to test new all-time highs at the end of the year. Who knows? I mean, these are speculative.
10 darts at a wall. One of them's going to hit the bullseye. Like, come on.
That's true.
Yeah.
One of them's going to hit the bullseye.
Oh, man.
Still a pretty large range, though.
Well, at least we all have each other.
Nah, you got Davis, man. I got nobody.
Dude, I'm in a couple group chats and it's been ugly today. Screenshots, all that. I mean, it's everybody. It's everybody. Like, I don't think people expected the velocity of the sell-off. We had a 10, 15% dip on a bunch of names. People are like, all right, let me step in. Then it goes down another 20%. That's when it's like, it just hits you like a brick completely. I mean, the pivot from January S&P basically all-time highs to first week of February, right back to almost November lows. It happens. And I don't know how many people went net short or net cash 2 weeks ago, but I don't think it's a lot of people. And that's why, most of us are feeling it right here.
Yeah. I think a lot of the indicators that people are now pointing to, this is the only thing that I have a problem with this too, is the Shiller Ps and the Buffett index or Buffett indicators and all of these things. Some of these have been flashing for extremely long periods of time.
Yeah.
And then everyone's pointing to these being like, it was so obvious looking back on it. It's like, no, dude, people were starting to lose respect for those indicators because they were not doing anything to the price.
Yeah, it's hindsight bias.
Yeah, of course.
What would you ask Jassy on the call? We got 7 minutes. Anybody here?
Why didn't you do 250, man? Why not? So what's 50 Billy? It's not going to matter.
No, I don't know what I'd ask, but the one thing that I really like about Andy Jassy is he has a mix of growth, but also margin, where I think Jeff Bezos was purely focused on growth. And so I think it's a more mature Amazon over the next 5-10 years. And I'm just excited to continue to hold this name. I know it's getting sold off, but I'm not actually concerned about the numbers that we're looking at here.
Those numbers are great.
Yeah.
They're amazing numbers.
By the way, the call's
Go ahead. What did miss? Guidance?
No, they don't do guidance. They missed
Dude, advertising service revenue went up 23%. Third-party sellers went up 11.2%. Physical stores went up 5%, but no one cares about that anyway. Online stores went up almost 10%. AWS 23.6%. And subscription revenue went up 14%, which, by the way, that was like the fastest since 2 years ago.
Yeah.
What's happening to your set, man?
They
It's
missed
the
APS.
bricks.
Dude,
The bricks are falling.
The Messi and Ronaldo thing fell.
Oh.
That's a sign about winning the game. Everything's dropping, bro. Like,
Not a
via
good
our
sign.
check. And by the way, Amazon does issue guidance, first quarter guidance. $173.5 billion to $178.5 billion in net sales. I don't know if it's a beat or a miss, but
oh yeah, you're right. They do. Well, they missed on EPS, but looks like the revenue guide, the midpoint is in there, so they did beat on the revenue guide, at least on the long end. AWS growing 24%, advertising growing 22%. With such strong demand for existing offerings and seminal opportunities like AI chips, robotics, low Earth orbit, satellites, we expect to invest about $200 billion in Capex.
Did we get anything for remaining performance obligation? Anything on RPO?
I think they say that in the call.
Yeah, they might.
Probably not here.
Yeah, I remember the last time they said in the call, but he just gave the percentage that it, well, yeah, they're not going to give the number. They just give the percentage.
Dude, the part that annoyed me was, wait, let me see if I find it. Operating margins. I mean,
Dude, Nebius is at $68, down 7.5% after having a down 10% day.
bro, it's going to zero. Everything's going to zero.
All the cloud names just showed off the biggest numbers you could ever possibly put up. And now Nebius on the day is down 18%.
What's
The
its
stock market should go to zero so that everyone has a generational wealth buying opportunity. Maybe that's what Trump is trying to do.
We won't even have any wealth to buy. That'll be it. We will be broke by the time that happens. It'll be game over.
I have a generational holding opportunity.
Yeah, yeah, there you go. Dude, Nebius is down almost 10% after hours, which means that its market cap is probably around $15-16 billion. ClickHouse alone is what?
28
How
billion.
much? So then, but they own 28% of it.
Oh, sorry, it's a 15 billion, but they own 20% of the yeah. So it's like half their stake in ClickHouse.
Yeah, like that's absurd. That's absurd. And Toloka and Avrite and all these other businesses are obviously worth a lot of money.
Hold on, is Meta dumping after hours? Oh boy, down 2% here on Meta.
Yeah.
Dude, Meta's earnings completely thrown out.
Swiped out
the wall.
Yeah, it makes sense to sell this name off, right? Meta.
Are we below 70 on Hood? No, we didn't touch below 70 yet, but it's pretty close.
Yeah. Neil, you own Rubrik? Yeah. Those are great earnings, right? Doesn't matter.
I mean,
doesn't matter.
The number, we don't know the numbers, but we know that they exceeded guidance. But yeah, it doesn't matter.
It doesn't matter when
doesn't
software's
matter.
selling off. Like there's just I think this is a great time because this is when the baby gets thrown out of the bathwater. They're just indiscriminately selling everything.
You know,
like everything. And it's great because now you can go shopping if you want to.
Time to buy depression stocks? Are we getting a bunch of like tobacco and alcohol companies, or what are we doing?
Oh, you know what? How much
I'd like to buy stocks with buy now, pay later options. Like I buy stocks now, I might pay them back later. I don't know. Could be a good new business venture.
A firm is down 4%. I forgot they reported.
I mean, for everyone for asking for year to dates in the chat, I think we're all red. I'm definitely negative year to date.
I'm not ready yet.
I'm red. I am red year to date.
Sam, did you say you're not red yet?
Not yet.
What the hell's holding you up?
Yeah, bro.
Like, what could you possibly have that's keeping you green, dude?
I'm still at 3%.
Oh, congrats, man.
Yeah. No, yeah, on semiconductor and Amcor are still doing pretty good year to date. Now is very heavily positioned with options.
Amcor's up 4% year to date.
Yeah, well, I mean, it's dropped down a lot, so that's been hurting. Zeta's been dropping down, so it is, and also I've been playing the hedging a little bit so far this year. So, I mean, it's a tough environment. Stock Talk is like, he's probably like 30% year to date, but ENS is down like 13% today. So, but I don't know how that guy does it because he doesn't really trade. So that's very difficult to do. He was on here earlier, right? I missed
Yeah,
that.
he was. Well, he was in a lot of these positions with options that exploded in January. So he was up like 60% year to date. Took a 50% drawdown. Now he's up 30%, which is still amazing. 30%. Problem is, do some of his other big, like we were talking about Amcor today privately. Like if Amcor gets hit pretty bad, it's tough for him. So he was talking about it. It's like even he's trying to navigate how to. And the only way you really save whatever performance you have so far, whether it's negative 10% or up 10%, is go to cash.
Not really. You can hedge. You can hedge.
No, sure, you can hedge. That's fair. But your hedge would have to be like delta neutral. Like you would have to buy puts or sell calls that are so close to the money that if we actually tank, you benefit, because it can't be far out and then we tank and then you have to wait for theta to help your hedge make sense.
I think that's the difficult part with hedging, is because you got to accept the fact, like a hedge is supposed to mitigate some of the drawdown. But like outright short in the market is how you make money as it goes down. But let's be realistic. We're in the middle of an AI cycle. We're going to be like laughing at this a couple years from now. I don't want to be short the market. Like this is probably as Jose was saying, like, look, if you're in it for the long haul, this is a great opportunity, right? Like you shouldn't really be worried about Amazon below $200 if it is not yet, but that should be a great opportunity, because now you're buying Amazon at a price to forward free cash flow, operating cash, not free cash flow, because it's not a free cash flow negative, but operating cash flow of like what, 13 now, which is insane. Meta's back at like 14 or 15. That's crazy. The 24% AWS, 23% advertising. They don't show how much advertising is on an operating basis, but that was a very high margin business. Both of those gross margin businesses are like 70, 80%. It's insane. Right. And you think that Amazon's going to go to zero? No, it's absurd. It's crazy, man. So, hedge the drawdown and then sell those hedges later on, and then use that to buy stuff back and cut positions that are low conviction.
All right, we got the call. Let's get into it.
See you guys in an hour.
Investor Relations, Mr. Dave Files. Thank you, sir. Please go ahead. Hello, and welcome to our Q4 2025 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2024. Our comments and responses to your questions reflect management's views as of today, February 5th, 2026 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates and energy prices, changes in global economic and geopolitical conditions, tariff and trade policies, resource and supply volatility, including for memory chips, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now I'll turn the call over to Andy.
Thanks, Dave. We're reporting $213.4 billion in revenue, up 12% year over year, excluding the impact from foreign exchange rates. Operating income was $25 billion, and trailing 12-month free cash flow was $11.2 billion. We're seeing strong growth, and with the incremental opportunities available to us in areas like AI, chips, low Earth orbit satellites, quick commerce, and serving more consumers' everyday essentials needs, we have a chance to build an even more meaningful business at Amazon in the coming years with strong return on invested capital, and we're investing to do so. We're already seeing strong demand in these areas, even in these early innings. I'll start with AWS. AWS growth continued to accelerate to 24%, the fastest we've seen in 13 quarters, up $2.6 billion quarter over quarter and nearly $7 billion year over year. AWS is now a $142 billion annualized run rate business, and our chips business, inclusive of Graviton and Trainium, is now over $10 billion in annual revenue run rate, growing triple-digit percentages year over year. As a reminder, it's very different having 24% year-over-year growth on a $142 billion annualized run rate than to have a higher percentage growth on a meaningfully smaller base, which is the case with our competitors. We continue to add more incremental revenue and capacity than others and extend our leadership position. We're continuing to see strong growth in core non-AI workloads as enterprises return to focusing on moving infrastructure from on-premises to the cloud, along with AWS having the broadest functionality, strongest security and operational performance, and most vibrant partner ecosystem. AWS continues to earn most of the big enterprise and government transitions to cloud. Since our last call, we announced new agreements with OpenAI, Visa, MBA, BlackRock, Perplexity, Lyft, United Airlines, DoorDash, Salesforce, U.S. Air Force, Adobe, Thomson Reuters, AT&T, S&P Global, National Bank of Canada, the London Stock Exchange, Choice Hotels, Accenture, Indeed, HSBC, CrowdStrike, and many more. More of the top 500 U.S. startups use AWS as their primary cloud provider than the next two providers combined. We're adding significant EC2 core computing capacity each day, and the majority of that new compute is using our custom CPU silicon, Graviton. Graviton is up to 40% more price performant than leading x86 processors and is used expansively by over 90% of AWS's top 1,000 customers. Graviton itself is a multi-billion-dollar annualized run rate business growing more than 50% year over year. We consistently see customers wanting to run their AI workloads where the rest of their applications and data are. We're also seeing that as customers run large AI workloads on AWS, they're adding to their core AWS footprint as well. But the biggest reason that AWS continues to gain AI share is our uniquely broad top-to-bottom AI stack functionality. In AI, we're doing what we've always done in AWS, solving customer challenges. Let me give you some examples. The first challenge is having a strong foundation model to generate inferences or predictions. Customers are realizing as they get further into AI that they need choice, as different models are better on different dimensions. In fact, most sophisticated AI applications leverage multiple models. Whether customers want frontier models like Anthropic's Claude, or open models like Mistral or Llama, frontier intelligence with lower cost and latency like Amazon Nova, or video and audio models like 12 Labs or Nova Sonic, Amazon Bedrock makes it easy to use these models to run inference securely, scalably, and performantly. Bedrock is now a multi-billion-dollar annualized run rate business, and customer spend grew 60% quarter over quarter. The second challenge is how to hone the model for your application. Customers sometimes think if they have a good model, they will have a good AI application. It's not really true. It takes a lot of work to post-train and fine-tune a model for your application. Our SageMaker AI service, along with fine-tuning tools in Bedrock, make this much easier for customers. A third challenge is how to have a custom version of a foundation model that best leverages a company's secret sauce, their own data. To date, companies have tried to shape models with their own data late in the process, usually with fine-tuning or post-training. There's debate in the industry about this, but we believe that enterprises will want models trained on their own data at an early stage, at pre-training if possible, so their models have the best possible foundation for what matters most to each enterprise on which to learn and evolve. It's a little like teaching a child a foreign language early in their life. That becomes part of their learning foundation moving forward, and it makes it easier to pick up other languages later in their life. To solve for this need, we just launched Nova Forge, which gives customers early checkpoints on our Amazon Nova models, allows them to securely mix their own proprietary data with the model's data in the pre-training stage, and enables their own uniquely customized versions of Nova, what we call novellas, trained with their data early in the process. This will be very useful for companies as they build their own agents on top of a model. There is nothing else out there like this today and a potential game changer for companies. Another challenge is cost. I've said this many times, but if we want AI to be used as expansively as companies want, we have to make the cost of inference lower. A significant impediment today is the cost of AI chips. Customers are starving for better price performance, and typically and understandably, the dominant early leaders aren't in a hurry to make that happen. They have other priorities. It's why we've built our own custom silicon and Trainium, and it's really taken off. We've landed over 1.4 million Trainium 2 chips, our fastest ramping chip launch ever. Trainium 2 is 30 to 40% more price performant than comparable GPUs and is a multi-billion-dollar annualized revenue run rate business with 100,000 plus companies using it, as Trainium is the majority underpinning of Bedrock usage today. We recently launched Trainium 3, which is up to 40% more price performant than Trainium 2. We're seeing very strong demand for Trainium 3 and expect nearly all of our Trainium 3 supply of chips to be committed by mid-2026. And though we're still building Trainium 4, we're seeing very strong interest already. Looking ahead, the primary way companies will get value from AI is with agents, some their own, some from others, and there are several customer challenges that we're well positioned to solve. It's harder to build agents than it should be. For that, we've built Strands, a service enabling agents to be created from any model. Once agents are built, enterprises are apprehensive about deploying to production because these agents need to securely and scalably connect to compute, data, tools, memory, identity, policy governance, performance monitoring, and other elements. This is a new and hard problem where a solution has not existed until we launched Bedrock Agent Core. Customers are quite excited about Agent Core, and it's unlocking deployments. Customers also want to leverage others' useful agents, and we've built several, including Kiro for coding, Amazon Quick for knowledge workers to leverage their own data and analytics, AWS Transform for software migration, and Amazon Connect for call center operations. We continue adding new capabilities, and usage continues to grow quickly. For example, the number of developers using Kiro grew more than 150% quarter over quarter. In addition to agents that customers direct, customers are also becoming excited about agents that require less human interaction. They can be fully autonomous, run persistently for hours or days, scale out quickly, and remember context. At this past AWS reInvent, we launched Frontier agents to do that. Kiro autonomous agents for coding tasks, AWS DevOps agents for detecting and resolving operational issues, and AWS security agents for proactively securing applications throughout the development lifecycle, and they're already making a big difference for customers. We expect to invest about $200 billion in capital expenditures across Amazon, but predominantly in AWS because we have very high demand. Customers really want AWS for core and AI workloads, and we're monetizing capacity as fast as we can install it. We have deep experience understanding demand signals in the AWS business and then turning that capacity into strong return on invested capital. We're confident this will be the case here as well. I'll now turn to stores. We continue to expand selection, including more than 400 new beauty brands in the US in 2025, like Bobbi Brown Cosmetics, Charlotte Tilbury, and Laura Mercier, and new fashion brands like Away Luggage, Converse, Diesel, Michael Kors, Nike, and The North Face. Our ultra-low priced offering, Amazon Haul, grew selection to over 1 million items under $10 and expanded to serve customers in more than 25 countries and regions. We continue to see strong customer response to everyday essentials and grocery. In 2025, everyday essentials grew nearly twice as fast as all other categories in the US, representing 1 out of every 3 units sold in our store. And we've become a go-to grocery destination for over 150 million Americans, mostly through online shopping and Whole Foods. With over $150 billion in gross sales, Amazon is clearly a large grocer at this point. Customers in thousands of US cities and towns can now get perishables delivered same day alongside millions of other items. And customers who use that service shop more than twice as often as customers who don't. We plan to expand in many more communities in 2026 And we also plan to open more than 100 new Whole Foods Market stores over the next few years as we work to make grocery shopping easier, faster, and more affordable for customers. We remain committed to staying sharp on price and continue to meet or beat other retailers' prices. A recent study from Profitero showed that Amazon is America's lowest price retailer for the 9th straight year, 14% lower on average than other major online retailers. We again achieved our fastest ever delivery speeds for Prime members around the world in 2025. In the US, we delivered nearly 70% more items same day than the year before. We also continue increasing speed for rural customers, with nearly 2 times more average monthly customers in rural areas receiving same-day delivery year over year. Same day is our fastest growing delivery offering, and nearly 100 million customers used it last year in the US. And the team is continuing to innovate. We've launched Amazon Now in India, Mexico, and the UAE, ultra-fast delivery on thousands of items in about 30 minutes or less. And we're testing it in several communities in the US and UK. It's early, but customers are loving it. For example, in India, customer response exceeded our most optimistic expectations, and we're seeing Prime members triple their shopping frequency once they start using it. Expanding our same-day delivery coverage also leads to meaningfully later cutoff times for orders, which is a big deal for customers. For example, on Christmas Eve, customers in about 4,000 U.S. cities could order items up until midday and get them that same day. Another example is our recently launched feature, Add to Delivery, which enables Prime members in the U.S. to add items to their upcoming Amazon deliveries with just one tap without going through checkout again or paying additional shipping fees. Just 6 months after launch, Add to Delivery already makes up about 10% of all Prime volume fulfilled through the Amazon network each week. While this seems simple on the surface, this feature is supported by a lot of invention where we need to figure out in real time and with incredibly low latency what items among Amazon's hundreds of millions of products are available to add to a customer's upcoming deliveries, surface them, find a way to include in their packages, and deliver within the same customer promise. The stores team is also continuing to innovate and deliver for customers with AI. Our agentic AI shopping assistant, Rufus, is rapidly expanded. Rufus can research products, track prices, and auto-buy, purchasing a product in our store when it reaches your set price. It can also now shop tens of millions of items in other online stores and make purchases for customers using our agentic Buy For Me feature. Last year, more than 300 million customers used Rufus. In addition, customers use Lens, our AI-powered visual search tool, to find products with a phone's camera, a screenshot, or a barcode, and they did it 45% more year over year. Moving on to Amazon Ads, we're pleased with the continued strong growth across our full funnel offerings, generating $21.3 billion of revenue in the quarter and growing 22% year over year. Sponsored products advertising in our store continues to be our largest ads offering, and the combination of trillions of shopping, browsing, and streaming signals with advanced AI and machine learning let us deliver highly relevant and useful ads for customers. We saw continued growth in Prime Video ads, which is now available in 16 countries and is contributing meaningfully to our revenue growth. Prime Video has an average ad-supported audience of 315 million viewers globally, up from 200 million in early 2024. Our ads team is also innovating with AI. We recently announced our ads agent, which lets brands use AI to create and optimize campaigns at scale, implement effective campaign targeting, and quickly create actionable insights. And our creative agent lets advertisers research, brainstorm, and generate full funnel ad campaigns from concept to completion using conversational guidance and Amazon's retail data, transforming what was a weeks-long process into just hours. We're also continuing to invent and see momentum in several other areas, and I'll mention just a few. Starting with live sports on Prime. The 4th season of Thursday Night Football broke more records. It was our most watched season ever, averaging more than 15 million viewers, a 16% year-over-year increase, and the 3rd consecutive year of double-digit growth. And the Packers versus Bears wildcard game was the most streamed NFL game in history with 31.6 million viewers, clearing the prior mark by more than 4 million. We just made Alexa Plus available to all customers in the US, free for Prime members and $19.99 a month for non-Prime members. Alexa Plus continues to get even better and more capable, And we've added new ways to interact with Alexa, including a new chat experience at alexa.com, a redesigned mobile app, and new integrations with third-party devices like Samsung TVs and BMW cars. We've also added new features like the ability to answer a Ring doorbell on a customer's behalf and more ways to shop or manage a home. And finally, the team is making rapid progress on Amazon Leo, which will bring connectivity to consumers, enterprises, and governments in places where they don't have broadband connectivity. Our enterprise-grade customer terminal, Leo Ultra, is the fastest satellite internet antenna ever built, delivering simultaneous download speeds of up to 1 gigabit per second and upload speeds of up to 400 megabits per second. Leo will offer enterprise-grade performance and advanced encryption with secure private networking that bypasses public internet, connecting directly to AWS. We've launched 180 satellites, have more than 20 launches planned in 2026, more than 30 in 2027, and expect to launch commercially in 2026. We have dozens of commercial agreements already signed, including with AT&T, DirecTV Latin America, JetBlue, and Australia's national broadband network, and have many more on the way. It's been an action-packed year of innovation and progress, and we've hit the ground running in 2026. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Starting with our top-line financial results. Worldwide revenue was $213.4 billion, a 12% increase year over year, excluding the 150 basis point favorable impact of foreign exchange. In Q4, we reported worldwide operating income of $25 billion. This operating income includes three special charges, which reduced operating income by $2.4 billion. The first charge of $1.1 billion is for the resolution of tax disputes associated with our stores business in Italy and the settlement of a lawsuit. This charge primarily impacts our international segment and is largely recorded in the fulfillment and other operating expense line items. The second charge of $730 million is for the estimated severance costs. This charge impacts all three of our segments and is recorded primarily in the fulfillment, sales and marketing, and technology and infrastructure expense line items. The third charge of $610 million is for asset impairments, primarily related to physical stores. This charge primarily impacts the North America segment and is recorded in the other operating expense line. Moving on to our segment results. In the North America segment, fourth quarter revenue was $127.1 billion, an increase of 10% year over year. International segment revenue was $50.7 billion, an increase of 11% year over year, excluding the impact of foreign exchange. Worldwide paid units grew 12% year over year, which was our highest quarterly growth rate in 2025. The fourth quarter marked a strong finish to the year as we delivered for customers during the peak holiday season. Our sharp pricing, vast selection, and record fast delivery speeds resonated with customers. They appreciated the convenience of receiving their items quickly, from gifts for family and friends to everyday essentials and perishable groceries. Our millions of global third-party sellers continue to be an important contributor to our broad selection. In Q4, worldwide third-party seller unit mix was 61%. We continue to invest in tools and services, including a comprehensive suite of AI tools that help our selling partners manage and grow their businesses. Shifting to profitability, North America segment operating income was $11.5 billion with an operating margin of 9%, up from an 8% margin in Q4 of 2024. International segment operating income was $1 billion with an operating margin of 2.1%. Excluding the impact of special charges mentioned earlier, the international segment operating margins also expanded year over year. We're pleased with the fulfillment network performance throughout the peak season. We made strong progress improving the cost structure of our network over the past few years. In the U.S., our regionalized network is operating at scale, and we've continued to make refinements. This regionalization has improved local inventory placement, leading to faster delivery and lower costs. Last year, U.S. Prime members received over 8 billion items the same or next day, up more than 30% year over year, with groceries and everyday essentials making up half of the total items. For the third year in a row, globally, in 2025, we achieved both our fastest ever delivery speeds for Prime members while also reducing our cost to serve. By leveraging our existing U.S. network, we can now deliver perishable groceries to customers in more than 2,300 cities and towns, all with same-day delivery. We saw significant adoption of this service throughout the year. When customers engage with our perishable offering, they demonstrate notably higher monthly spend compared to those who do not shop the category. We also see that customers shopping perishable groceries add 3 times more items to their same-day delivery orders. Looking ahead, we see further opportunity to enhance productivity in our global fulfillment network while delivering at faster speeds for customers. We will continue optimizing inventory placement to drive down distance traveled, reduce touches per package, and improve package consolidation, as well as launch robotics and automation to increase efficiency and elevate the customer experience. Shifting to advertising. Advertising revenue grew 22% in the fourth quarter, and we added over $12 billion of incremental revenue in 2025 alone, as our full funnel advertising approach of connecting brands with customers is resonating. Simplifying the advertiser experience to enable brands to better reach customers wherever they are. Moving next to our AWS segment, revenue was $35.6 billion, and growth accelerated to 24% year over year. We added $2.6 billion in quarter-over-quarter revenue, and AWS now has an annualized revenue run rate of $142 billion. This acceleration was driven by both core and AI services as customers continue to modernize their infrastructure and migrate workloads to the cloud. Our AI offerings continue to resonate with customers, including our agentic capabilities. This growth was helped in part by the more than 1 gigawatt of capacity we added in Q4. In 2025, AWS added more data center capacity than any other company in the world. AWS operating income was $12.5 billion. We're seeing strong top-line growth while remaining focused on driving efficiencies across the business. This includes investing in software and process improvements to optimize server capacity, developing a more efficient network using our lower-cost custom networking gear, and advancing custom silicon. At the same time, we continue to rapidly develop products and services on behalf of customers. As we've long said, we expect AWS operating margins to fluctuate over time, driven in part by the level of investments we're making at any point in time. Turning to cash flows, our full-year operating cash flow increased to $139.5 billion in 2025, up 20% year over year, due primarily to improved operating income and changes in working capital. Now turning to our Q1 financial guidance. Q1 net sales are expected to be between $173.5 billion and $178.5 billion. This guidance anticipates a favorable impact of approximately 180 basis points from foreign exchange rates. As a reminder, global currencies can fluctuate during the quarter. Q1 operating income is expected to be between $16.5 billion and $21.5 billion. A few things to mention on the operating income guidance. Within the North America segment, we do expect a year-over-year cost increase of approximately $1 billion related to Amazon Leo. We have more than 20 launches planned in 2026 and more than 30 in 2027, which means we're spending more on launching satellites each year. Select enterprise customers are testing Amazon Leo services now, and we expect a wider commercial rollout later this year. As a reminder, today we do expense most of these Leo costs as incurred. We expect that later in the year, many of these costs, such as satellite manufacturing and launch services, will be capitalized. Within the international segment, we're continuing to invest more in our stores business to enhance the customer experience and to encourage retail demand to move online more quickly. This includes bringing faster delivery options, including Amazon Now, our service which delivers to customers in 30 minutes or less. We're also working hard to stay sharp on pricing and seller fees. And there are countries where we've had to be more aggressive to meet or beat competitors' prices. We like these investments because they will delight customers, grow our business, and we believe they will generate long-term positive return on invested capital. As we enter 2026, I'm energized by our team's strong execution. I want to thank everyone across the company for their hard work on behalf of our customers. We remain focused on driving an even better customer experience, which is the only reliable way to create lasting value for our shareholders. With that, let's move on to your questions.
All right, Q&A.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press *1 on your telephone keypad. We ask that when you pose your question, you pick up your handset to provide optimum sound quality. Once again, to initiate a question, please press then 1 on your touchtone telephone at this time. Please hold while we poll for questions. Thank you. Our first question comes from the line of Mark Mahaney with Evercore ISI. Please proceed with your question.
Okay, thanks. I think, Brian, let me throw this to you or maybe to Andy. On the strong long-term return on invested capital, I think that's the debate in the market today. So could you give us a little bit more insight into how you think investors will be able to see that? Either talk about the duration of the Capex cycle that you're going through now, or what we should see in terms of profitability levels, and maybe also talk about like other de minimis or minimum free cash flow generation levels that you don't want to go below as you go through this Capex cycle. Just help us, get to that, get to your level of confidence in having a strong long-term return on that invested capital. Thank you.
Yeah, sure, Mark. Thank you. I'll start from a financial side. So on the investments we're making, as Andy said earlier, we are putting into service with customers all capacity that we're getting, and it's immediately useful. And we're also seeing a long arc of additional revenue that we see from other customers and backlog and commitments that people are anxious to make with us, especially for AI services. So you can see that's working its way into our P&L, both through Capex and also through our operating margin in AWS. AWS is 35% operating margin through Q4, up 40 basis points year over year. As we talked about before, that is going to fluctuate over time. It certainly has a headwind from the investments in AI and the depreciation on that Capex. But we also work very hard to offset that with efficiencies and cost reductions. So we will see how that develops over time. So, we see strong return on invested capital. We see strong demand for these services, and we continue to like the investments in this area.
I would add to that, if you look at the capital we're spending and intend to spend this year, it's predominantly in AWS. And some of it is for our core workloads, which are our non-AI workloads, because they're growing at a faster rate than we anticipated. But most of it is in AI. And we just have a lot of growth and a lot of demand. And when you're growing 24% year over year with an annualized revenue run rate of $142 billion, you're growing a lot. And what we're continuing to see is as fast as we install this capacity, this AI capacity, we are monetizing it. So it's just a very unusual opportunity. As I've shared a lot of times, I passionately believe that every customer experience that we know of today is going to be reinvented. With AI, there are going to be a whole bunch of customer experiences that none of us ever imagined that are going to become the norms of how we all operate every day and what we use. And I think the other thing is that if you really want to use AI in an expansive way, you need your data in the cloud and you need your applications in the cloud. Those are all big tailwinds pushing people towards the cloud. So we're going to invest aggressively here, and we're going to invest to be the leader in this space as we have been for the last number of years. We have, I think, a fair bit of experience over the years in AWS of forecasting demand signals and doing it in such a way that we don't have a lot of wasted capacity and that we also have enough capacity to serve the demand that's there. And I think we've also proven with AWS over the years in how we build data centers and how we run them and how we invent in there. If you think about our chips and our hardware, our networking gear, and how we've invented in power, that this isn't some sort of quixotic top line grab. We have confidence that these investments will yield strong returns on invested capital. We've done that with our core AWS business, and I think that will very much be true here as well. And I think some of the things that you will see over time in the AI space is you're going to keep seeing all the inference services, which is going to be the majority of the long-term AI workloads is going to be inference. You're going to see the inference keep getting optimized. You're going to see higher utilization on those services. You'll see prices normalize over a period of time. And then I think the companies that have not just the excellence in infrastructure, but also the components that give customers better price performance and give those companies themselves better economics are going to have advantaged financials. And I think if you look, we're already off to a really good start having Trainium underneath the majority of our Bedrock service. And that's not just giving customers better prices, but it also gives us better economics. And so we see that following the same sorts of patterns we saw in the early days of our core AWS investment. I'm very confident we're going to have strong return on invested capital here.
And the next question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks so much for taking questions. Can you just talk about how Project Rainier is running with Anthropic after its first full quarter? And I think in the release, it talks about 500,000 chips, but a few months ago, you talked about getting to 1 million as well. So if you could clarify that. And then maybe just to follow up on Mark's question, are there any financial guardrails or governors in place that we should think about around the spend, just in terms of operating income growth or positive free cash flow? Thanks.
Yeah, I'll start with the Trainium piece. We are very excited about the growth that we see in Trainium and the future that we have there. I think if you look at what's happened in the early innings of AI over the first few years, you see a lot of usage, but customers are really thirsty for better price performance. And Trainium has 30 to 40% better price performance than comparable GPUs, so it's very compelling to customers. You mentioned Project Rainier. Anthropic is building their next, they're training the next Claude model on top of Trainium 2. And that's what Project Rainier is. We talked about 500,000 chips there. You will see that continuing to increase. They're also using a fair bit of Trainium 2 for other workloads and their own APIs beyond just Project Rainier. But Trainium is a multi-billion-dollar annualized run rate business at this point, and it's fully subscribed. And what you're also seeing is Trainium 3, which is the next version of Trainium, which we just started shipping. That's 40% more price performant than Trainium 2. And there's very substantial amount of interest there. We expect that nearly all of that supply will be committed by somewhere around the middle of this year. And we're just in the process of building Trainium 4. There's very substantial interest in Trainium 4, which is coming in 2027. And we're already having conversations about Trainium 5. So there is a lot of interest in Trainium at this point. And I think I think people know about our chips capability, our chips business, but I'm not sure folks realize how strong a chips company we've become over the last 10 years. If you look at what we've done with Trainium, if you look at what we've done with Graviton, which is our CPU chip, which is about 40% better price performance than comparable x86 processors, 90% of the top 1,000 AWS customers are using Graviton very expansively. If you combine Trainium and Graviton, it's well over a $10 billion annualized run rate business. It's still very early there. So I'm very optimistic about what we're seeing. We have, the Project Rainier has gone very well. I think Anthropic is quite pleased with it. We've learned a lot in the process as well, but it's early days with what's possible here. This is a big business that's getting bigger and has a lot of potential. And I'd briefly comment on your second question that, we are, as I mentioned, this is what, I think this is an extraordinarily unusual opportunity to forever change the size of AWS and Amazon as a whole. I think it also is an extraordinary opportunity for companies to change all their customer experiences, and for startups to be able to build brand new experiences and businesses that would have taken much longer to try to accomplish before that they can do right now. And so we see this as an unusual opportunity, and we are going to invest aggressively here to be the leaders, because like we've been the last number of years, and like I think we will be moving forward.
Thank you. The next question comes from the line of Ross Sandler with Barclays. Please proceed with your question.
Great. Andy, you mentioned a few calls back how the AI market was currently a bit top heavy, with a lot of the spend kind of clustering around a few of the AI native labs. So how is that changing as you look out into 26? And specifically, how do you think you might extend your relationship with a company like OpenAI to maybe help Amazon's AI efforts, both on the retail side and the AWS side? Thanks a lot.
Yeah, the way I would describe what we see right now in the AI space is it's really kind of a barbelled market demand, where on one end you have the AI labs who are spending gobs and gobs of compute right now, along with what I would consider a couple runaway applications. And then at the other side of the barbell, you've got a lot of enterprises who are getting value out of AI in doing productivity and cost avoidance types of workloads. These are things like customer service or business process automation or some of the fraud pieces. And then in that middle of the barbell are all the enterprise production workloads. And I would say that the enterprises are in various stages at this point of evaluating how to move those, working on moving those, and then putting them into production. But I think that middle part of the barbell very well may end up being the largest and the most durable. And I would put in the middle of that barbell too, by the way, I would put just the altogether brand new businesses and applications that companies build that right from the get-go run in production on top of AI. And so I think that, to me, when I look at this, what's happening, it's kind of unbelievable if you look at the demand of what you're seeing already with AI, but the lion's share of that demand is still yet to come in the middle of that barbell. And that will come over time. It will come as you have more and more companies with AI talent, as more and more people get educated with that AI background, as inference continues to get less expensive, and that's a big piece of what we're trying to do with Trainium and our hardware strategy. And as companies start to have success in moving those workloads to further and further success in moving those workloads to run on top of AI. So I think it's just a huge opportunity. It's still in the relative early stages, even though it's growing at a very unprecedented clip, as we've talked about. And then I think, how do we see our relationships extending with other companies like OpenAI? I would tell you that this movement and what's happening in AI is it's very broad. It's going to be a lot of companies. It is a lot of companies already. There's a number of AI labs, but almost every company you talk to, almost every conversation we have on the AWS side starts with AI. And so we have very significant relationships with a lot of different companies. I think we announced an agreement with OpenAI in November. We're excited about that agreement. It's a big one. And we have a lot of respect for the company, and we hope to continue to extend our partnership over time. But this AI movement is not going to be a couple companies. It's going to be thousands of companies over time.
Thank you. The next question comes from the line of Michael Morton with MoffettNathanson. Please proceed with your question.
Hi, good evening. Thank you for the question. This one's on the retail business. Andy, you've talked about how you're passionate this is going to change experiences across the board, and you've shared some encouraging data points on Rufus. And we're seeing all the other internet platforms roll out agentic protocols. I would love to see how you think this plays out for the retail business and the on-site ads portion of the retail business. Is what seems like it could be a compression in the funnel as consumers get better answers over time. Anything there would be great. Thank you.
I'm very optimistic about the customer experience that will ultimately be what customers use for agentic shopping. And I think it's good for customers. I think it's going to make it easier for them. It's a big piece of why we've invested as significantly as we have in our own shopping assistant in Rufus. And if you haven't checked out Rufus recently, I really encourage you to do so. It's gotten much, much better and it keeps getting better every month. And, we have 300 million customers who used Rufus in 2025. Customers who used Rufus are about 60% more likely to complete a purchase. And so you're seeing a lot of usage of it and a lot of growth, and I think it's very useful. And I think at the same time, we will have relationships with third-party horizontal agents that can enable shopping as well. We have to collectively figure out a better customer experience. It's still, these horizontal agents don't have any of your shopping history. They get a lot of the product details wrong. They get a lot of the pricing wrong. And so, we have to try to find a customer experience together that's better and, a value exchange that makes sense for both parties. But I'm very hopeful that we'll get there over time. We continue to have a number of conversations. And then I think you're going to have to look at, as time goes on, which types of, which shopping agents are consumers going to use. And it kind of reminds me in some ways of the early days of kind of all the search engines that were referring traffic to retailers. And, it's still a relatively small portion of the overall traffic and sales. But of that fraction, you have to ask how many consumers are going to prefer using a horizontal agent where it's kind of a middle person between the retailer and the consumer versus wanting to use a great agent from that retailer that has all its shopping history and that has all the data right there and makes it easy if you're just spearfishing for something to shop for it right there, or if you want to do discovery, you can do it there, and it's got the best data on shopping. I think a lot of customers are ultimately going to choose to use a great shopping agent from that retailer. Because if you think about what consumers really want in retail, in a retailer, they want really broad selection, they want low prices, they want really fast delivery, and then they want a retailer that they can trust and that takes care of them. And I think horizontal agents are pretty good at aggregating selection, but retailers are much better at doing all four of those items. And so I'm very optimistic that people will use our shopping agent. It's off to a great start. I also expect that we'll work with other third-party agents over time as we work on the issues I mentioned earlier.
Thank you. The next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Thanks for taking my question. Andy, I want to ask you one about the global retail business this year. I know there's a lot of areas of investment in it that you're talking about to sort of make improve the service, make it more durable over the long term, et cetera. But I'm assuming there are also sources of efficiency you expect to see this year. So can you sort of help us understand both sides of the ledger on retail this year? Where are some of the areas where you see the potential for sources of efficiency and cost to serve savings? And then where should we be thinking about the areas of investment to sort of drive more durable growth, robotics, et cetera? How does that sort of break down?
Yeah. So I would say on the side of continuing to invest to keep growing the retail business, the kind of core drivers of demand continue to be the same. We're going to work really hard to expand selection, and you've seen what we've done over the last several years. The expansion of selection has been broad, and you'll see it on both ends of the spectrum. We have a lot more of those luxury brands that have built presences in Amazon, had success, and found that we could manage their brand presentation the right way, and they've been very happy. I mean, you only have to look at L'Oreal as an example too, of just how fast that business is growing and how happy our partners have been. And at the same time, we are working really hard to continue to expand the amount of everyday essentials that we offer our customers. And the growth in everyday essentials in our business is really remarkable, as I mentioned in my opening comments. And 1 out of 3 units now that we move are everyday essentials. And what we find there is that the more that customers can rely on us for everyday essentials and the lower ASP items, they just choose to do more of their downstream shopping with us in every way. We're just more front of mind. And so, I think a big piece of why we have captured more and more of those everyday essentials, and you see it also in our grocery business with perishables too, is just our speed of delivery improvements over the last 3 years has been really marked. I mean, it's customers. It's the one thing I get stopped on the street most often about, which is I just can't believe how quickly from when I order something I get it to my door and how reliable you are. I think along that speed of delivery piece, it's also quite interesting what's happening with quick commerce, and we have this offering called Amazon Now that we've largely started outside the U.S. and India and the UAE and Mexico that gets thousands of items to customers within 30 minutes. And it really is, it's quite interesting how quickly that is growing. And I think that it's just another one of those things like everyday essentials that when you're able to order more and more from Amazon, you just think of Amazon first if it's a great experience that we're offering for whatever you're looking for. But if you look in India, which is the place we've rolled out quick commerce the fastest, customers who try quick commerce are shopping with triple the frequency than they did before they tried us on quick commerce. So those are all areas I think are pretty excited that we're expanding. You'll see us continue to expand what we're doing on the perishable side too, which we're quite excited about. We are able to deliver perishables same day in thousands of cities around the world now. In the cities in which we have those perishables available, 9 of the 10 top items that are ordered in that geography are perishables. So we're just having a lot of success with that too. And people who buy perishables from us, after they buy perishables, they're shopping with us twice as frequently. So a lot of good things to like there. And then, on the efficiencies, we always have a very long list of these that we're working on, Brian. And it's true today as well. Like if you look, even, I talked a lot about regionalization in our fulfillment network, and particularly in the U.S., over the last couple of years. And I said we weren't done honing that, and that's true. It's just we don't talk about it every time. But if you look at what we've done there, we've extended the number of regions. It was 8, it's now 10. We've extended regionalization to what we do with our inbound delivery to be much more efficient, being able to get more items closer to customers more quickly. We have we're doing a lot of work, and we've made a huge amount of progress in being able to get more units into each box. And as we're able to get more units into each box, it obviously saves shipments, and we drive better operating income when we do that. And we've made very significant progress there, but have a lot more planned. It's part of, by the way, that improvement is part of what helps us do things like I was talking about earlier in adding to a delivery in near real time. And then, robotics, as you mentioned, is another big one for us. We have over 1 million robots today in our fulfillment network. They take care of all sorts of functions, but still a fraction of what I think we're going to be able to enable over time, which will allow we'll always have a lot of people that we employ in our fulfillment network, but they'll leave to the robotics things that, that are more repetitive. So it's better productivity for the business, more safe for our teammates, and there's real cost efficiencies in that as well. So a lot on both sides of the ledger, as always.
Thank you. And our final question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks so much for taking the question. Maybe a few parts just on AWS. Can you speak to the current state of your revenue backlog as of Q4? and also discuss a little bit about what you see both for internal use cases and external client needs with respect to any imbalance between supply and demand around AI efforts, and how you think about closing the gap on those as more capacity comes online through 2026. Thank you.
Yeah, that's a lot of parts. I'll start with the first one, which is on backlog. Our backlog is $244 billion. That's up 40% year over year. I think it's up 22% quarter over quarter. We have a lot of deals that are in the pipeline. There's just, as I mentioned earlier, there is a lot of demand for AWS right now in the AI space and also in the core AWS space. Your second question was internal and external use cases. I would, and then the impact around supply and demand. The vast majority of our the capital that we spend and the capacity that we have is consumed by external customers. Amazon has always been a very large AWS customer, a very helpful AWS customer, because they're very demanding and they use the services very expansively and stretch the limits as we launch things. So they've always been a very important, big customer, but always a very small fraction of the total, and that's true today in AI as well as the overall AWS business. Internally, we have all sorts of ways that we are using AI. We have over 1,000 AI applications that we've either deployed or in the process of building, and they range from our shopping assistant in Rufus that we were just talking about, to Alexa Plus, which is a really large-scale generative AI application, to applications in our fulfillment network that allow us to have more accurate forecasting predictions, to how we do customer service and our customer service chatbot, to how we are making it much easier for brands to create advertisements and to optimize all of their campaigns across the full funnel of advertising options we have. To in live sports, if you watch Thursday Night Football, you can see defensive alerts which predict which player is going to blitz, or pocket health. I mean, in every one of our businesses, you see a very broad use of AI to improve the customer experience, and in many cases, just to completely reinvent what was possible before. I mean, it's pretty neat to use something like Lens, where you may see something you want to buy, you can just take a picture of it in the app, and it finds the item on the detail page. You can buy it one click. It's kind of magic. Externally, I would say it's kind of what I said earlier. You have AI labs, consuming lots of capacity, both for training as well as for the inference and the research across what they're doing with their different applications and models. We see enterprises, all sorts of workloads, customer service automation, business process automation, fraud, completely reinventing their applications, agentic coding applications, legal applications. Suno is a really cool example of an AWS customer that's kind of reinvented how you can write music and build music. So really across the board. And I just think on the supply and demand, what I would tell you is, we're growing 24% year over year on a $142 billion annualized run rate business. So we're growing at really an unprecedented rate. Yet I think every provider would tell you, including us, that we could actually grow faster if we had all the supply that we could take. And so we are being incredibly scrappy around that. If you look, in the last 12 months, we added 3.9 gigawatts of power. Just for perspective, that's twice what we had in 2022 when we were an $80 billion annual run rate business. We expect to double it again by the end of 2027. We added 1.2 gigawatts of power in Q4, just quarter over quarter. So So our team is being aggressive and scrappy and inventive and adding capacity as fast as we can. We'll add a lot more in 26 and 27 and in 28 for that matter. And we're very optimistic we can continue to grow in the ballpark of what we have.
Thanks for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon, and we look forward to talking with you again next quarter.
All right. That was Amazon. Stock's down 10%. It is an absolute bloodbath after hours. Iren is down 25%. S&P. It's not funny, Tanner.
Dude, I did not know that. I'm sorry. You just took me by surprise.
I hope Iren is not signaling what'll happen to Nebius, but if Nebius even stays flat on their earnings, I mean, there's been a debate between Iren and Nebius. Maybe that debate is resolved if Nebius can stay relatively flat. But Amazon's down 10% on a $2.3 trillion company is heavy. Ethereum's down 11, Bitcoin's 63.8, Palantir's down 2. I mean, it's disgusting after hours. This is becoming an absolute bloodbath and getting a lot worse. Tanner, what was your reaction to the call? Anything you learned from that, or it doesn't matter because everything else is red?
After I laughed at the Iren thing, I just saw a comment that said, "Tanner, bro, shut up." My bad, guys. I really I wasn't looking at Iren.
Also, hold on. Before we continue, shout out to Jake, who's on the train home from work. He just tagged us in this. He said, shout out to Tanner for giving me a little bit of joy on a dark day. This was earlier in the show.
I have a generational holding opportunity.
Yeah, there you go.
Yeah, cut out the front though. Not much context on that joke, but yeah, thank you.
Only Tanner would be anal enough to be like, yeah, but the front of the joke was cut. Like, goodness, bro.
That wasn't a bad impression. I
gracious,
like that
bro.
one.
Only Tanner, guys. Only Tanner. Anyway.
Okay, so honestly, I just sound like a broken record. The market is taking a crap, and I get that, but Amazon sounded very confident that they are going to see almost an immediate ROI on this spend. And they're essentially saying, hey, we've been a leader in this space for like a decade now. Well, okay, that's funny. Amit laughs like a dolphin. But they know that they're not just setting this up. This is not a brand new space for them. They said, as fast as we can install this capacity, this AI capacity, we are monetizing it. So I'm confident. I know the market hates it right now, but it's just because they see a lot of upside in this space. Everything that Andy said, I'm a subscriber to. I think that, AI is just going to fundamentally change all work. We're going to see experiences that none of us have ever imagined. They said they're going to invest aggressively. And whenever the companies are investing aggressively, I almost want to match that while buying shares in their companies. I want to invest aggressively in their optimism. They're a lot smarter than me. I as an investor, I get to sort of put my chips on those shoulders of the giants, we're on the shoulders of giants. I get to bet on their success. And I believe Amazon is definitely making the right moves, and they have a lot of data to back that up. So it's a crappy place to be, fully aware that we are in an absolute meltdown right now. But it's Amazon. They're not going anywhere.
Jose, your thoughts on the call?
Yeah, I hate when Tanner goes first because he just takes everything I want to say. But I agree. I mean, I'm a simple man. I buy chips. I see who's buying the chips, and it's these big cloud service providers. They're saying they're going to buy more. The valuations on a lot of these companies aren't that crazy. So the market sucks, but I'm actually pretty excited. I was just trying to find ways on how to make more money so I can just put more money into the market as soon as possible. I think it is an amazing opportunity for the market I'm in. So yeah.
I'm also starting a Substack called What the Tanner Happened. So if you guys want to hear what I have to say or what Jose has to say just before he posts it, I can do that for you.
Yeah.
Neil, your thoughts on the call?
Honestly, whatever they said, and there is still enough demand, not enough supply. We'll keep growing. We want to improve our services more and more. And I mean, before the call even started, you said if we're going into a recession, who's going to shop, right, with Amazon? But I think if we are going into a recession, it's a company like Amazon that people are going to shop with because the prices are much better, because the service is better, because you get same day delivery or next day delivery. So no matter what situation, Amazon is going to do very, very well in the future. But yeah, I'm laughing again. I'm laughing, but I'm just looking at the price action after hours, like Amazon below 200, things getting absolutely destroyed. So everybody's here trying to create a side gig. I'm probably going to do stand-up comedy or some therapy session or whatever. But this is some crazy stuff. Like, okay, I know the markets are only 2% or 4% from all-time highs, blah, blah, blah. I couldn't care less. You have like the biggest companies on the planet, the most profitable companies on the planet that are not even trading at crazy valuations that are down 10, 20, 30% or so. Crazy names that are down 30% on one day. I mean, PayPal seems to be the one that was quite early with the big pullback, because everything else just followed with the minus 20%. Or now 35% with the after hours, if not more. These are crazy moves. Yes, this is a nice comment.
Yeah, and again, the thing is, it's really unavoidable. Like, it's not like you're in one sector and outside of being purely in value stocks, any part of growth right now is getting hit. So whether it's Iren or the Mag 7 or energy name, like space, everything is just getting wrecked right here, no matter what you're in. And I think that's what makes it worse. A, we don't really have a reason for why it's happening, like we did last year. B, it kind of feels like it's more getting prolonged. C, the V shape is every day that goes by where we don't see the hints of the V shape or the hints of indices recovering certain moving averages, the V shape looks less likely. And then finally, it's like if the market's not going to react to good earnings, 24% AWS growth, beat all the expectations, then what are they gonna react to? Charles, thanks for the super chat. Please save your money. Do not send the super chats. I know it can get a little rough for a lot of people, but thank you for the super chat. Here's my last $10. What if Apple has been the real AI winner this whole time? Tanner, any thoughts on that one?
If Apple has been the real AI winner this whole time, no. No, I think the companies that are spending a lot are the winners, but it's just the market has a hard time believing it, but they also have not been proven right. It's not like the companies spending a lot are not seeing it back in cloud growth or increased operating margins or eventually flowing down to free cash flow. I mean, we are seeing that. It's just, we're also seeing increases in capital expenditures because they see a bright future. I don't think that means that the companies that are not spending like Apple are the real winners. I mean, that they've always been more of the safer blue chip or like the safer names of the Mag 7, think like value names. So of course there's going to be a general rotation, but yeah.
Especially when the market has been rewarding the CapEx spend, right? So like Apple seems like it's safety right now because the market hates CapEx spend, but the market has been rewarding it. So I think the big question for all of us is to figure out, why does the market suddenly hate the CapEx? And I think, Jose, you were mentioning earlier, maybe we're pulling forward too much CapEx.
Yeah, I think that's what the market is thinking, right? I think we're pulling to it kind of reminds me a little bit of like NVIDIA when we kind of started this AI race. It's like the market kept wondering from NVIDIA, are you going to be able to grow more next quarter? Are you going to be able to grow more this quarter? Or you are going to be able to grow more next quarter? Now, I don't think that's a question anymore for NVIDIA, but now kind of like pushing that same sentiment here to these big players is like, you're spending more in CapEx, but can you make more money with that CapEx? Oh, you're spending more CapEx. Can you spend more money? And it's like, the market is just not understanding that this AI story is as real as it gets. And it's like 2-3 quarters from now, we're going to be like, oh, yes. I mean, Mark Zuckerberg, was a great thing. He spent CapEx in the early 2021s, 2022s for the metaverse, right? Luckily, he got lucky that Capex, that infrastructure was AI infrastructure, and he quickly transferred it into the AI space. Now I think we're going to see something similar where now everybody's doing that same thing, and a few quarters from now, everybody's going to be like, oh, look, they actually made the right decision by spending this Capex. I think right now the market is just like, I mean, it's crazy to think that just 3 companies are going to spend like what, $500-600 billion in the next 12 months. Like, I'm pretty sure that's a lot bigger than a lot of other, that's many countries in the world. And 3 companies are going to be spending that type of money in just the next 12 months.
I agree.
But it doesn't matter. It doesn't matter. Like, this is the thing with the market right now. We can talk and talk and talk, but it doesn't really matter much. Like last year, we had the DeepSeek. We had explanations for everything that's going on. Today, it's just things go down because, I don't know, cloud work and plugins, and it can do this. It can create a better Excel. Also, we're talking about Microsoft a lot, right? The fact that Microsoft has come down quite a lot, but the fact that Claude does better things in Excel that Microsoft Copilot does, that just doesn't make any sense to me from an execution standpoint.
But isn't that why Microsoft, I guess, is now integrating Claude and all those into its platform? Like, I think we saw Claude Opus 4.6 just came out, and it said it's being used in all 3, in the Foundries, Google Cloud, and the other. And I think Microsoft is also going to be integrating it within Copilot.
Yeah, this is ugly. This is ugly after hours. I mean, obviously, I think a lot of people feel that at some point we get to a bottom, but every bounce also, even intraday, has been met with resistance. And so it really messes with your psychology, right? If you think of, all right, this is the bottom, I'm buying into strength. I mean, a lot of these names, another $3-4, they have to go down before even getting a little bit more of a bounce before going down again. So, and then tomorrow's a Friday. Options are expiring. You tend to get a natural sell-off on Fridays. I mean, I don't know if the dip buyers come in for Amazon tomorrow, but...
And apparently there is an election in Japan on Sunday. Snap election on Sunday could also impact the global markets. I don't know who's going to get elected. I don't know what they're going to do with their yen, but I'll say it again. If you still have money left, it's still time to go to Japan because it's quite cheap. Still, it's very nice.
Yeah, sorry. I apologize. I've been a little quiet. I'm just thinking about, Amit and I are going to have to move back in with our parents. And I'm just sort of putting the pieces together about how I'm going to explain to my girlfriend that I took from the joint account and that it wasn't for groceries and all this stuff. And where did it go? Well, there's this things called Neo Cloud. She's not going to know what I'm talking about. It's just, I'm in a world of trouble. So,
dude, I bought an $8 latte this morning, and I'm looking at myself like, bro, you're not in the position to be buying. I gave a 20% tip. Like, I was like, you know what? Maybe.
Where do you buy your coffee, man? At Louis Vuitton? What is this?
No, dude, it's this local spot near me. It was just like, all right, screw it. And then I don't know. I thought it'd be okay, but so it's not even caramel. It's like vanilla, honey butter. It's like a healthier version of caramel or some shit. And I'm like, why am I doing this? This is not a smart financial decision. And I barely even drank it, dude. I had like 3 sips. Like, it's
I don't even know how I'm going to tell her that the proposal is going to get pushed off even further. The engagement's going to be long, dude. But hopefully the market returns quickly before. No, I'm just kidding. I'll be fine, for real.
You will see on Facebook Marketplace, girlfriend for sale, pickup.
Yeah, no more buying GF. I'm selling GF. But what was I going to say?
Yo, you have to have SoFi for a wedding. You got to hit up Noto, bro. Be like, hey, man, I need some help.
Yeah. Well, I was just going to say, though, this is the advantage, though, of, not being levered up and having short-term options and everything like this. That, I mean, it sucks that, we're down on the portfolio, but I'm not actually sweating any blow up of the portfolio or anything along these lines. Like, I do feel extremely insulated, and the companies that I'm in, I don't actually think are weakening. I think they're doing well. Sentiment's changing. Can sentiment turn around? I mean,
basically what you're saying is Nebius could go to $10 and you're not going to get margin called. And that's not the same for everybody. And I think the takeaway from that is just got to delever right now. Got to delever. And it might suck to delever right now because this might be the bottom, right? Like this might be where Nebius, everything, I ran at 30 is the bottom and then it bounces. But if it's not and you're levered, this is the tough part about margin, right? And money's been so, or gains have been so lucrative and so quick for the past 3 years, which is why margin debt is at such high levels, not just for retail, but also the institutions have been levering up like crazy. Long-term capital management, people should look up the story of that hedge fund and how they got levered back in the 90s. Maybe the smartest thing is to just take some chips off the table right now.
Starting with, my girlfriend's Netflix account that's going to get turned off tomorrow, so I can save a little bit of money.
She's going to start getting ads.
Yeah.
Yeah, there's probably some subscriptions that I don't need. They're leaving.
$8 lattes. You're going to go get the ground coffee tomorrow.
I'm just going to go back to drinking water in the morning. That's it.
Yeah.
Oh boy. Yeah, this is, I've talked to a lot of different people the past 2 days and everyone has the same question, which is why is this happening? And I have the same response. You guys have the same response. I'm sure the chat has the same, which is like, we don't know. We really don't know. It can give you a couple of different theories, but there's not like a definitive, like, oh, Trump's screwing us with reciprocal tariffs. It's like, no, that's not it. That's not it.
Yeah.
Sandra, this Valentine's Day, it's got to be a gift we make from home, right? We can't go buy one. We have to make one from the heart.
She's getting a macaroni necklace for sure. But for real, I think that she thinks she's getting something nice, and we're gonna have to try to, change the expectations somehow.
Millie says, what if institutions are selling everything to cover margin calls on silver? That's why money isn't going anywhere. It's paying off debt. Maybe. I mean, maybe institutions are selling to, this is kind of yen carry trade, right? If they're short something and then it blows up, you have to sell something to cover it. But the type of structural liquidations we've seen over the past 2 days, it's hard to explain. It really is. I mean, it's full on just like melt. I mean, SoFi under 90. These are levels you just didn't think you would see at Robinhood into 70s. But it's here.
And we're not done yet, my friends. We are not done yet. And then let me ask you, do we still want 24/7 markets, or are we okay with having like a weekend off where we don't have our net worth being slashed by 20% on a daily basis or something? I'm fine with weekends not having to look at stock markets,
I mean, I still like the idea of 24/7 markets. Be your own adult and step away from the markets when they're when you don't want to participate.
Bloom lost the pump.
But you're still going to go down even if you step away.
It's either I just have to wait till a random time of 9:30 in order for me to watch a massive spike, or I watch it slowly go down. I mean, it's no different.
Bro, my friend just texted me. He said his roommate is heavy in Iren. And he said he went to the gym and he probably doesn't even know what happened. His roommate just texted him saying he didn't even go to the gym. He just sat in the parking lot and stared at the stock the whole time.
Well, for real, because this is serious money, and I do make a lot of jokes. Losing a lot of money very quickly can
oh my goodness, silver, bro. Sorry, Tanner. 18% down. Okay, go ahead. Sorry.
Yes, I can buy a silver necklace then.
Yeah. Luckily, the jewelry is getting cheap as my market's sinking.
19%.
But for real, all joking aside, for some people, this is severe mental stress. Past the portfolios and past everything, your health is worth so much more than that. So if this is getting really, really scary, and what you're not wanting to hear right now is 4 losers laugh about your portfolio blowing up right now. Yeah, I don't like.
Oh, straight up, just don't watch. Stop watching us, right? Like, don't watch.
Stop watching us. Stay calm. Don't look for roof access or anything like this. You know, it's
Look, all of us are going to cover the day-to-day swings of the markets. I don't think we're planning to stop. Even if it gets into a bear market, it's going to be, mentally taxing for all of us, but we're not going to be stopping. So if you can't handle the day-to-day swings, you just don't want to look at the portfolio and you're not levered, so you kind of don't need to sit and wait for the margin call, then put the phone away and leave financial media for a while until things get better. I mean, honestly, I so agree with Tanner. We're making jokes right here to cover a little bit of the pain, but you have to protect your mental right now because things can get very ugly when it comes to money, and protecting your mental health right now is the most important.
On top of that, can I do an announcement? So I'm not going to say any names. I'll be interviewing someone tomorrow. This is super, super exciting for my community, for Amit's community, like for everyone. I can't give much away. I'm interviewing someone. It's going to be unreal. I've not had the conversation, so I don't know what we're going to talk about. But it's of a public company, and obviously today's going to make that conversation a little different because everything's dropping right now. Yeah, this should be very, very exciting. It was crazy. While we were getting this set up, there was probably 4 or 5 people, executive assistants, corporate communications, IR, all these people in the chat and everything. This is a big one. So I'm super excited. And that while we're doing the interview tomorrow, it'll be pre-recorded. They told me nothing's off the table. And in fact, they even gave a couple questions that they would like to answer. And I read the questions that they also wanted to touch on. And I was like, they want to answer some hard questions. So they're giving us full access. They also said that they want to post it same day. So it's going to come out Friday as well. It'll be recorded and dropped on Friday.
Oh my
Tomorrow,
God.
I mean. That's my announcement.
Going to interview Trump for a Canadian-US trade deal, ladies and gentlemen.
Bro, if Trump offered me a gold card, I'd ask for its cash value. I need $1 million. I would say, like, the dips are so good, I'd wait on American Access right now. I need cash. Holy.
So what time tomorrow? What time tomorrow?
What?
What time are you releasing it tomorrow?
We're not exactly sure. It's looking to be in the evening, probably 5, 6, something like that. But honestly, I don't have an exact time just yet.
Okay.
Yeah, apologize.
All right, so Tanner's YouTube, make sure you check it out. It'll be out tomorrow. I think it'll be a great podcast. Steve and I's podcast, by the way, is probably going to come out on Saturday. It's not going to be out today. So for those waiting for Steve and I's podcast, it will be out likely on Saturday. We decided to not put it out today, kind of fixing up a couple things, but it'll be out Saturday. And yeah, it's a new market we're in. Obviously, it's pretty aggressive and ugly, but we're going to be trying to navigate it every single day. All right, folks. Thank you all for joining. We'll be back tomorrow. Next week, we have a bunch of earnings. It'll be about 2 weeks until we have NVIDIA. And we will keep going from there. Again, I just really want to echo what Tanner said. Like in the midst of all this, it's really important to take care of your health, mentally and physically. It's important to remember you have family and friends, people that love you, and markets are markets. They're going to go up, they're going to go down. Part of the reason you get these asymmetric gains is because there's also asymmetric pain on the other side, and you kind of just have to go through it if you're going to be investing more broadly.
Yeah.
All right. Thank
you,
everyone.
Stay here. I don't want to go outside and see my wife just yet.
Yeah, I mean, also, I don't have a wife, but I've also had to talk to family members, and they're hard conversations you have to have with some people, especially if you're the guy that they expect to have answers. So I know some of you guys probably have to deal with that as well, and it's part of being
going to be mad or upset as well. Davis is going to be pissed.
I don't have a husband either, but I did talk to Davis today. So, yeah, it's part of the journey.
Whatever. Yeah. I want to be culturally appropriate. I don't know what you. Yeah, I support you. All right, let's wrap it up.
Tomorrow is
All
a
right, guys.
brand new day. Fresh opportunities.
We'll be back tomorrow for the market open. We'll see how this all plays out. Thank you all for being here and watching. Amazon down 10.4% after hours. And time will tell to see if we can recover from here. Thank you, everybody. See you guys tomorrow.